I think right now the street really is more focused about the risks tied to AI.
We've got what I call AI derangement syndrome.
Right now, everyone's focused on the losers, how AI is going to hurt.
It's just hard to really square this momentum, this sentiment.
We need more diversification away from technology.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, a domino falls. Jack Dorsey's blog taking a massive bet on AI, slashing its workforce, cutting almost 50% of its staff. Dorsey writing this: the intelligence tools we are creating, paired with smaller and flatter teams, are enabling a new way of working. On a call to analysts, he had a warning for the competition. I don't think we're early to this realization. I think most people are late. And the stock move may help others get there even sooner. Block is absolutely surging, up almost 20% in the pre-market.
This story encapsulates the entirety of the week to me, and frankly of this year, which is the key debate. How much is AI going to cannibalize from human labor and leave the jobs market with big holes? And how much are we looking at a lot of companies that are using AI as an excuse to get rid of underperformance, especially if they overhired? On one hand, you've got the doom scroller saying that this is the telegraphing of what is to come at other companies, and this is how you monetize it. On the other hand, they're saying, well, Block was down 25% last year and down 16% so far this year, was bloated and was trying to trim around the edges. AI, a convenient excuse.
So which one is it? And we can get into it. That's the debate right now. Is this a domino or the first domino? And there's more to follow. Or is this just trimming post-pandemic bloat at the company?
It's like a Band-Aid. And if you think AI is going to be that disruptive and you're an executive, do you just rip it off quickly, or do you want to do a slow, gradual, basically depreciation of your workforce? But not just what it's been down in terms of the stock for the past year, down more than 70% over the past 5 years. So I find it a little bit interesting that Jack Dorsey says none of this has to do with financials.
This quote is doing a lot of heavy lifting from Jack Dorsey. We're not making this decision because we're in trouble. Our business is strong. Gross profit continues to grow.
And this is a reason why some of them are actually getting spooked, and why it is making the rounds, because it is speaking to something that people already feel. How do you monetize AI? Ultimately, with greater efficiency. How does that lead to monetization? Either broadening your footprint and getting more business, consolidating market share, or laying people off and having the AI bots do what they're doing. Look, whether Block is actually doing this purely because of technological advancements, and this actually is a roadmap, is almost besides the point. The fact that it has taken on a life of its own in markets tells you the mood of markets and just how self-conscious everybody out there is right now.
This is a green light. I'd go one step further. This could be a green light for others to follow. This could be cover just to make the cut you've been waiting to make, particularly with a move like that in the pre-market, up by close to 20%. It's difficult to imagine they'll be the only ones, regardless of whether this is post-pandemic blow or this is the real deal.
But that's the reason why it's so hard to delineate which is which. And this is the reason why so many people have said, yeah, there are big companies that have come out. There was one in Australia saying something very similar, saying it's so difficult to know whether that's actually the case or whether it's a convenient excuse. Oh, it's not us doing badly. Oh, it's not our faults. We're just subject to the new technology that's being bestowed upon us. At the same time, the fallout seems to be considerable. It's just that it's not here right now. It seems like this has been the most existential week in markets I've ever experienced. And all of the doom scrolling and different substacks on Twitter, I've gotten totally lost in them. It seems like everybody is in this debate.
Okay, Bramo? Do you need some time?
I think
I'll take some time.
I think Ed Yardeni would say you might have, what is it?
AI derangement.
100% I do. Absolutely.
But then you have to think, I wish Ed Yardeni was on today. What would he say to Jack Dorsey and this message that he posted, this statement about how much he is just relieving of the workforce because bots are going to take their jobs?
It's a massive move from Block and Jack Dorsey. We'll talk about it throughout this morning. The name is higher by close to 20% in the pre-market. Coming up this hour, we'll catch up with Stephen Auth of Federated, with the S&P heading for a small monthly loss. Dolev of Mizuho as Block slashes almost half of its staff. And Krishna Guha of Evercore as the Fed weighs tax impact on the labour market. We begin this out with stocks sliding following yesterday's chip rout. Stephen Auth, the Federated, lowering his year-end price target on the S&P to 7,500 and writing this: the sell-off was overdue, given the violence of the last few weeks. We remain cautious on software names, as many are potential value traps. Steve joins us now for more. Steve, welcome to the programme. I've been looking forward to catching up with you, sir. Really interesting note. I think we should start from this. You are not bearish. You still think earnings are going to be OK. This seems to be a call on valuation, Steve. Just share with us your thoughts about how your thoughts on valuations are developing and comparing now to maybe where we were a few decades ago.
Yeah, Jonathan, actually, the piece you cited was really inspired by a conversation you all were having on surveillance a couple of weeks ago about the confusion around the macros seem to be pretty good, yet the market is having trouble. And I think what we're saying is that the reason the macros are pretty good, but the problem with the market right now is that there's a whole hunk of it that was dependent on two different arguments for why it should have a higher valuation. One is the Mag 7 were giant free cash flow generators with big moats around them, and free cash flow is worth more in terms of a dollar earnings than an asset-heavy company because the dollars that come right back to the shareholders are supposed to have to be reinvested in the ground or a big piece of a big asset. And the Mag 7 are no longer free cash flow generators, at least for the present, because they're spending 80% of it, 90% of it on AI. And the debate around NVIDIA versus the Mag 7, or the rest of the Mag 7 is this going to go on forever or is this a one-off? And that debate's really not settled. So you've lost the free cash flow. And then on top of that, you've got all these asset-light businesses, Block being a perfect example, that, a couple of guys in a garage coding software, and that they were all the rage for the last 10 years because you didn't need any assets at all to generate earnings. It's all intellectual capital that you're selling at very high margins. And the question is, can those margins hold up in a world where your competitor is now AI, not a software engineer? And so those businesses are under pressure, and the valuation is a question mark. And so when you put the two together, the valuation, the idea of a fair valuation on the S&P, we think is lower than it was 6 months ago. So we've we've increased our earnings forecast, actually. We're at 410 3 years out now on earnings, which is ahead of the street a little bit because the macros look good. But a lot of that acceleration in earnings is coming outside of the set of stocks I just talked about. It's coming in, lo and behold, the asset-heavy businesses, that are actually doing pretty well, which, by the way, includes Europe and Japan and Asia and Korea, which I know you guys have also been talking about. But a lot of those businesses are the very businesses that are enjoying part of this pickup. They're beneficiaries of AI, and they're less prone to being cannibalized by AI.
So, Steve, as you know, for a long time, for much of the last decade, the US equity market, the index, has demanded a greater valuation, a higher premium compared to the rest of the world. Is that eroding before our eyes? Is that something that's not repairable given the shifts that you describe?
Well, I think it's still going to probably attain a premium for what it's worth. We've cut our long-term estimate on the multiple for the market from 22 to 20, whereas everything else we'd still say roughly call it 18. So we think it's still a premium for one because it's got a more fulsome capital market, more flexible, et cetera. And we've kind of exaggerated to make a point on asset light, high free cash flow. Sooner or later, the big Mag 7 companies will start generating cash flow. Either AI, again, free cash flow, either AI is going to work and they're going to have a lot more profits, or it's not going to work and they're going to pull back and generate free cash flow that way. So one of the things that's, I think, attractive about the Mag 7 here, and we think you can sort of pick within those, we like Amazon as an example right now, but one thing that's attractive about it is at some point they still are, their base businesses are still very, very profitable, and they can just return to that if they have to. So you're not dealing with a mirage in terms of what you've got here, and no one else really has that. So yeah, I think you're right. The premium's probably lower than it was, but we still think there's a reason to have a premium there. We just have cut it back. And really what we're trying to signal to our clients is we're probably in a kind of single-digit return market here, not a double-digit return market. And if that's the case, that changes what kind of stocks you want to own. As an example, dividend stocks, which are a big hunk of the value indices, you can get half your return in cash, basically, or at least a third of it. And, that starts to look a lot more attractive, a 3 or 4% dividend yield against an 8 or 9% market, as opposed to against a 15 or 20% market.
The story you're telling, Steve, seems to benefit companies that are harder to disrupt. I don't understand why NVIDIA isn't among those. I don't understand what happened yesterday, why the shares are down 5.5% after delivering earnings that beat expectations with 75% margins and talking about, ongoing pipeline that's really significant. What's the tell for markets in terms of this response to earnings that otherwise were pretty good?
Right. Lisa, one of the issues is there's not one narrative here. So the harder to disrupt narrative, that's really kind of the software names, high intellectual capital names. NVIDIA is not a completely asset-light business. It's a high free cash flow generator, and it falls into that ilk. NVIDIA is, in some ways, the primary beneficiary of the AI build-out, right? I mean, everyone needs their chips, and it's a pretty powerful story. That's why the stock has done so well in the last 5 years. But the debate around AI kind of centers on NVIDIA in a way, right? Either of these Mag 7 companies, they would say, hey, we're kind of in a one-off spending cycle here. Once we get to nirvana, we'll be back to being high free cash flow generators. If that's the case, where's NVIDIA going to sell to, right? Because they've got to replace last year's sale first before they even start next year's sale. So on the other hand, if this is going to go on forever, and if you listen to Wang, he would say it's going to last 10 years, well, then NVIDIA is a screaming buy here because it's the only player in town. Maybe you could say AMD. So there's a real debate around NVIDIA right now. It's not a stock we hate, frankly. We would still be involved with that stock for that reason. It's not going to get cannibalized here. That's not going to happen. The question is AI going to work?
Yeah.
And is it going to keep growing out? And if it does, NVIDIA is a screaming buyer.
Steve, I just want to finish up. I know you're a really deep thinker, and I'm sure you've been following some of these Substacks and some of the arguments and discussions around the future of the labor market and humanity in the wake of AI. What's been your response to this week and sort of the increasing flurry that kicked off Sunday evening with Citrini's research and then, spurred all of the rebuttals and then the pile-on?
Well, one reason we've been signaling to our investors, look, there's a violent rotation we're in the middle of, more's to come, is we don't want people to panic when that happens. So frankly, we're not in a panic, as you might guess, because we're probably mostly tilted where we want to be. In terms of the Citrini research, it's very interesting, but frankly, I may be a deep thinker, but I don't know that I have the imagination fully to guess where this economy is going to go. But all I know from watching the history of economic development over the last 500 years, every time there's a major invention that disrupts the current status quo and the economy grows as a result of the efficiencies and productivity enhancements that happen, and this is huge this time around for sure, somehow or other, those XX personnel, if you will, get redeployed to even a higher value-added activity, and the economy grows even more. And I just got to believe that there's a lot of entrepreneurs out there that are going to figure out a way to use those very high talented, white-collar workers to do even more. And I know within our own business, we're seeing that at Federated, Hermes, and I think a lot of other businesses are seeing the same thing. So it's not necessarily the case. I think it's the folks that don't have the imagination that are left expecting, the doomsday scenario. I just don't see that. It's never happened before, and I don't think it's going to happen now.
Steve, I'm not a doctor, but it doesn't sound like you've got AI derangement syndrome. It's good to see you, sir. Steve Auth there at Federated Hermes, the latest on the equity market. Fantastic note from Steve and the team. Well worth a look through.
Yeah, are you saying that, in other words, other people do have AI derangement syndrome?
I'm saying some people might.
I feel a lot better after listening to that. The human creativity will reign supreme. And this is sort of the counter argument. Look, yes, he is talking about the asset light and asset heavy, and he's talking about much more, quotidian things that we could actually focus on.
The index has changed.
Yeah,
and the valuation this index demands is shifting, and we're all trying to keep up with that. Futures this morning on the S&P negative by about 0.4%, with an update on stories worldwide this morning. There are many. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Yes, John, and we start with Block. Those shares are trading higher in the pre-market, up more than 18%. The company announcing it's cutting its workforce by nearly half, or 4,000 employees. CEO Jack Dorsey saying AI is changing the future of labor productivity, adding, I don't think we're early to this realization. I think most companies are late. Within the next year, the majority of companies will make similar structural changes. Meanwhile, Anthropic rejecting the Pentagon's latest offer in a dispute over safeguards around the use of its AI technology by the military. The company insisting it doesn't want its technology used for surveillance of U.S. citizens or autonomous lethal strikes. Anthropic has until 5:01 p.m. Eastern today to give in to the Pentagon's demands or be labeled a supply chain risk. And Netflix dropping out of the bidding war for Warner Brothers Discovery. The move clearing the way for Paramount's guidance to buy the Hollywood studio. Netflix saying the deal is no longer financially attractive after Paramount's latest $31 a share offer. That's your Bloomberg Brief, John.
Hey, Yahara, thank you. Thanks for the update. More from Yahara later this hour. Up next on the program, the job loss debate.
AI is solving tasks. AI is not replacing jobs. This whole idea that AI revolution is going to replace all of us, I think it is just wildly exaggerated.
Jack Dorsey might have other ideas. Dan Dolev of Mizuho joins us next, live from New York City this morning. Good morning. Such a strange month. Futures down about 0.4% at the moment, and on the month down by a similar amount coming into Friday. And if we decline at those kind of levels, even down by 0.4% on the month, the biggest monthly loss since April of 2025. That tells you how good this index has had it, going through 25 and into 26. Those gains have stalled. The Nasdaq is down by a third. The Russell is down by 0.9%. Lots of stock stories out there. Let's talk about the big race for Warner Brothers. So Paramount wins, or did they? Netflix, investors have other ideas. That stock is up by more than 8% in the pre-market.
Netflix coming out and saying that we don't think that this is financially worth our time. They dropped out after Paramount's bid for, I believe, $111 billion for the Warner Brothers name. Now the question goes to regulators. They've got a $7 billion breakup fee in terms of any questions around regulation. What is Congress going to say about uniting CBS and CNN at a time when this is clearly on everyone's mind?
Congress is going to say it is an antitrust disaster. At least one individual in Congress, Senator Elizabeth Warren. This is going to be incredibly complicated the next few months, and there's a target on this back of this deal.
We'll keep tracking that story. We're tracking this too. Block in the pre-market. What a move we're seeing in early trading, higher by almost 20%. Under surveillance this morning, the job loss debate.
AI is solving tasks. AI is not replacing jobs. And we all in our jobs, some have fewer tasks in their jobs, some have more tasks in their jobs, but there really is very few people, if anyone, in the US economy who only have one task. This whole idea that AI revolution is going to replace all of us, I think it is just wildly exaggerated.
So here's the latest this morning. Block taking a big bet on AI labor productivity, slashing nearly half of its workforce. The co-founder and CEO, Jack Dorsey, saying, I think most companies are late. Within the next year, I believe the majority of companies will reach the same conclusion. Dan Dolev of Mizuho has an outperform rating on the stock with a $100 price target. Dan joins us now for more. Dan, welcome to the program. Jack Dorsey says something has changed. Dan, what's changed?
Well, I mean, the fact of the matter, the key question here is how much of it is really AI versus, and I believe I've seen tweets by Block that they've overhired, right? So, I mean, there's definitely an AI component here. And it's clear, he said, I think on the call yesterday, that something happened in December. The models got a lot better. I think the answer is probably not kind of black or white. The answer is probably like there's some component here that's AI driven and efficiency driven, but some component of just natural trimming of the portfolio of employees.
Well, Dan, you know the business better than most. Take us inside the company right now. How do you draw a distinction between it being one versus the other?
Well, the key, I mean, I look at some precedents, right? You look at when Elon took over, and I'll get to your question in a second. When you look at when Elon took over Twitter, I mean, didn't they fire like 50% of the employees? And that was not AI driven. It was just bloated, right? But in terms of the company itself, right, like they're all remote, right, for Block or Square. Everyone's fully remote. I think Jack, after COVID, said fully remote forever. So the question is, like, I would say not so much the number of employees, but the efficacy of the employee base, right? I don't know the answer to that, but there must be something there in terms of productivity that they're adjusting.
Dan, what's the template for other software companies and financial services companies that you cover in terms of whether they're going to have to execute similar cuts, even if they're not entirely due to AI, but just for efficiency drives at a time when the focus is how do you monetize some of this new technology and not become victim to it?
Yeah, I think it's a great question because what I'm hearing since yesterday at 4 p.m. whenever they reported is everyone's worried, and I think this is kind of reverberating throughout the entire, at least my universe, the payments, fintech, crypto universe. It sets a precedent to everyone else, right? Like if you think about Jack Dorsey, and I've followed him for a long time, right, co-founder of Twitter, he's always very, very early, and that's the worry here is that there might be some of it. I think the extent here, to your point, I think the extent here is not entirely AI. There's definitely some trimming that is, they said AI, but it's not entirely AI, but you're going to see some of this across the board in other companies as well.
Is this what's required to actually get software off the ground? In other words, if you start to see some pretty significant layoff announcements across the board, will that get people more excited about the sector again?
I mean, if you're judging by squares or blocks, sorry, I'm dating myself here. It's, at least they didn't change the name today. How about this? This is the good news here. Same name. I guess chopping the block or something. I don't know. Maybe that's the new name.
That's good. I thought of it as Square too, Dan. When I first saw the tweet, I was like, "Isn't this just Square?" Are they just going to use? Are they just going to? You think more companies are just going to use AI now just to trim the fat?
Yes. I 100% agree. But yeah, I mean, if you think about going back to your other question, if you think about, the response of the market, and I think it's fading a little bit. It was up like 25+% pre-market. Now it's up 18, 19. I think people are going to look at it and say, hey, am I going to get a stock bump by just saying that I'm cutting the workforce because of AI? So yeah. I think that's the fear is more just like a popular sport of trying to get your stock up.
It's what we said at the top of the program. Will this inspire others to do exactly the same thing? Dan, when you heard from Jack Dorsey yesterday, were you given a picture of how these savings will be used, what they'll do with this capital, this money?
Not really, and that's actually a great question. So we're going to be digging into this like in the next coming days. The key question that I'm hearing from investors, and the institutional investors, like what's the ROI here and how much of it is going to be reinvested into the company? So I don't think there's a clear answer from the company of how much of this is really being used for further, future growth or just, giving more EBITDA or operating income to the shareholders.
Dan, can we finish on the human touch?
The key debate.
Can I just squeeze in this question? We see Square, and I'm used to calling it Square still, in retailers across the country. How much of a relationship business are they in? How much do you need people to speak to the retailers, get in touch with them, visit?
That's the most important question. And I can tell you that's the reason. If you think about like some of the other competitors, like, Toast or, anyone that, Global Payments, a great company, Fiserv with Clover is a great company. There's a huge human touch here. Let me just give you one example. If you're running a restaurant and it's 12 a.m. or whatever, midnight, and the point of sale, just breaks up, you don't care about a bot answering. You want to make sure that your restaurant keeps working. So there's a massive human relationship touch to this entire merchant acquiring space that people don't appreciate. And if they cut too much, Square does, then it might backfire because of that human touch element.
Dan, appreciate your time. Thanks for making time for us this morning. Dan Dolev there of Mizuho. We asked the question about 30 minutes ago. Is this about trimming the fat, the post-pandemic blow? Is this the real deal? I think Dan's point is we're not sure yet. It could be a bit of both.
And it could be a good excuse for others to do the same, as we were talking about earlier. This idea that essentially, if you want a cosmetic bounce to your stock and you're a software company, why don't you announce 5 people getting laid off because of AI and everybody will cheer?
It's quite a bounce, and it's more than 5 people. We're up by 18% in the pre-market. Coming up, we'll catch up with Eswar Prasad of the Brookings Institution on dollar dominance. Plus, Yahira has your morning movers. Shares of Block or Square soaring after a massive workforce cut. That name absolutely surging. Equities still within a few percentage points of all-time high stateside. Equities this morning negative by 0.4%. Vicious moves this month beneath the surface. We'll spend some time on that for you throughout this morning. Heading towards the close of February, on the Nasdaq, we're down 0.33%. As we close out this month, take a look at the scores year to date worldwide. The FTSE, the Nikkei, The Kospi, the FTSE 100 up by close to 10% year to date. The Nikkei 225 up by 17%. The Kospi up by 48%. South Korean equities up by 20% this month.
Yeah, and up about 50% so far this year at a time when people are looking to the likes of Samsung and saying, well, actually, they're perfect because they're less disruptible than some of U.S. tech, and guess what? They're at a discount. Jim Reed put out a great chart yesterday of Deutsche Bank talking about how these stocks have moved from cheap to world-beating to now expensive. And today, on the margins, you did see record global bond fund managers, stock fund managers sell in Korean markets because they want to capitalize on these gains.
Massive focus on this. I think it's a bright light on international, the outperformance in international equities right now. Not enough focus on this. Take a look at bond yields. 2s, 10s, 30s. 10s on the month, down by 25 basis points. 10s this morning, 398. That is a major move.
You have 10-year yields sub 4% at the lowest levels going back to November of last year. What is the bond market telling us? And this is what everyone keeps wondering. Is the bond market signifying that there is weakness? Is it signifying this massive disinflation? Or is it signifying maybe that there is going to be ongoing sort of global pressure on bond yields at a time when we're using deficit spending to build things out? I mean, I'm not sure that I totally understand this move, and I'm not sure that I'm getting full cohesive explanations elsewhere.
I'm more surprised by just how little attention it's attracting, that we've drifted through 4. Wouldn't you expect headlines all over the place this morning about breaking 4% on 10s?
It doesn't cohere with any narrative, John. What would you do after that? It broke through 4%. Then what? Is it because of the Fed? No. Is it because of something that the Treasury Department is doing? No. Is it because you think that the global growth is going to fall off a cliff? No. It's just sort of grinding lower, and it doesn't really cohere to any other narrative, so people are just letting it go.
In the face of all these reasons for yields
to go higher.
Should be higher.
Correct.
It's notable. We're down by 2 basis points to the long end of the curve as we count you down to the opening bell 3 hours away. Let's get you some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Hollywood's big bidding war just ended, and investors are cheering both sides, both Paramount, Skydance, and Netflix soaring in the pre-market after Netflix walked away from its bid for Warner Brothers Discovery, giving Paramount the inside track on a $111 billion mega deal that, if approved by regulators, could redefine who owns Hollywood's most valuable franchises, with David Ellison at the center of it all. Meanwhile, we are seeing shares of Block soaring more than nearly 18% in the pre-market, trimming some of its gains after Jack Dorsey announced one of the biggest restructurings or boldest restructurings yet in the age of AI, saying that they will slash nearly half of its workforce, arguing that with its AI tools, it could do more with fewer people. And while Block has struggled in the past, it just came off a solid earnings report, and management is arguing it is doing this from a position of strength. The bigger question now, is this the start of something bigger, more companies following suit? Jack Dorsey sure seems to think so. And we end on CoreWeave. It's a sharp sell-off there. Shares are down 11% after it unveiled massive spending plans up to $35 billion of CapEx in 2026, something we know investors have been quick to punish, especially if you're not living up to the hype. And that was the case for CoreWeave. It posted a deeper loss than expected, but CEO Mike Intrater made clear he is unapologetic about how much money they're spending. John?
Yahara, thank you. Thanks for the update. More from Yahara later this hour. Speaking of interest rates, some good news on the mortgage front. The average 30-year mortgage in this country sliding below 6%, the first time we've seen that since 2022. This time last year, that number was much closer to 7%, and we're right on the brink of spring selling season. So some encouraging signs on that front.
Yeah, let's see if that actually travels through to some of the numbers that we've been seeing. So far, the housing market just hasn't gotten off the foot. I mean,
not great.
Home Depot and Lowe's just reiterated that, given the fact that there just hasn't been that catalyst to really reignite the market.
I saw this from Redfin, Lisa, just the other day, this stat right here. Nearly 1 in 7 home sales are falling through, a record for this time of the year.
Yeah, and the fact that you haven't seen people solidify. You have seen this trend that has been growing. You also have seen the sales turnover at the lowest rates that we've seen since 2009. I mean, it's really been a dramatic market, and this is really a key point for, frankly, the political season.
Labor market anxiety sky high right now. I imagine that's influencing the way people approach to some of these deals. in the housing market. More on that a little bit later. On our radar this morning, London's market Financial Solutions is collapsing, leaving giants like Barclays and Jefferies scrambling. The fall echoing recent failures in the US, adding to fears that global banks are unable to detect massive collateral fraud. Elsewhere, Block slashing its workforce by nearly half, cutting 4,000 employees. The CEO, Jack Dorsey, saying AI is changing the future of labour productivity. Shares of Block surging in pre-market trading higher by more than 18%. And finally, Netflix officially dropping out of the Warner Brothers bidding war. The streaming giant saying the deal is no longer financially attractive following Paramount's latest offer of $31 a share.
This is fascinating on a couple of different fronts. First of all, this was more existential for Paramount versus Netflix. Paramount saw them as losing dominance to the Netflix and the Disneys of the world, so they had more of an incentive to overbid potentially, at least in Netflix's eyes. So they won, at least in the bidding war. Now the question is the regulatory front and how much pushback they're going to get, given the fact this really is some of the major news networks and it's a consolidation of a lot of what we've seen coming out of Hollywood.
And that'll be center stage next week. There's a judiciary committee. And they're going to be back there for a hearing. This is March 4th. And once again, Senator Cory Booker has extended an invitation, I believe, to David Ellison, not the father, but David. Not sure if he's going to be attending. But speaking of attendance, you have seen a massive push, not just from Paramount, but also Netflix, not just what's going on in Hollywood and the debate there, but the influence they've been trying to garner in Washington, D.C. David Ellison was a guest of Lindsey Graham at the State of the Union. Lindsey Graham allegedly was spotted at the White House yesterday. Obviously, the Netflix CEO was down in Washington, D.C., and was at the White House yesterday. So a lot of pressure from both these companies trying to put on lawmakers.
The Netflix piece of this is intriguing, because on a morning like this morning, to see both Netflix and Paramount up in the pre-market, I think is notable. And there seemed to be a gap opening up between the C-suite at Netflix and the shareholders, who were starting to question why we're even looking at this deal.
Look, for Netflix, it isn't quite as existential, and I think that was the point. And the issue is that they were going to pay more and more money for a company that just reported earnings, and frankly, they were just flat underwhelming. There is a lot of work that needs to go into some of these properties. So it doesn't seem like the market is upset with this outcome. It seems like the market is saying, maybe this is the right way.
A bidding war, and both sides won. Netflix up by 8% of the pre-market. Dollar dominance very much in question. Let's talk about the FX market. The currency down nearly 10% from a 52-week high. Eswar Prasad of the Brookings Institution writing the dollar remains secure on its pedestal. The reason, though, is less the power of US exceptionalism and more the weakness of America's rivals and allies. Eswar joins us now for more. Eswar, a warm welcome back to the programme. It's always good to hear from you, sir. Let's talk about the rivals and allies, Europe and China. Can you talk to us about those two currencies and why they're unable to be in a position to topple the US dollar?
So the euro, when it was created back in 2000, certainly looked like it might rival the dollar because, after all, the eurozone does match the US in economic heft. It has many of the institutional strengths that one thinks are very important in supporting a reserve currency, including an independent central bank, the rule of law, system of checks and balances. But the problem is simply, Jonathan, that Europe hasn't gotten its act together. The European Monetary Union has certainly been established. Banking Union has made progress, but the payment system still remains fragmented. The financial system remains quite fragmented. And, of course, there are centrifugal forces that continue to threaten to pull the Eurozone apart. So the Eurozone looks very shaky. And if you look at the safe part of the Eurozone, the core Eurozone economies, it doesn't look like those account for a large amount of the bonds issued by the Eurozone. Now, we know that a German Bund is not quite the same as a Greek bond, although, of course, the riskiness of those assets has shifted over time. But the reality is that despite its depth, there is a sense that financial markets in Europe are not integrated enough to provide the quote-unquote safe assets that the world needs. And the reality is that both the political and economic weakness of the Eurozone has meant that the euro cannot really rival the dollar. China is not willing to open up its capital account fully. It continues to manage the exchange rate, both of which make investors very wary of investing in China. And most importantly, China does not have the trust of international investors because of the very weak institutional framework. None of the elements that I spoke about earlier, the rule of law, the independent central bank, the checks and balances are there in China. So China, for all the desire it has to make the renminbi a prominent international currency, is not really playing on the same field.
One argument has been that technology, which is rapidly shifting, will actually allow some of these global payment systems to gain some clout at the expense of the dollar. You take the opposite view. You think that actually the increasing technology around the financialization of global markets will actually benefit the dollar. Can you explain?
It's again a compelling proposition that if you think about new payment systems, for instance, China's cross-border interbank payment system, which can directly communicate with the payment systems of other countries, including Russia, India, Brazil, and so on, you could reduce the need for these vehicle currencies like the dollar, which serve as an intermediary between these pairs of currencies. And some of that is certainly happening. But the reality is that you still need a trusted currency in order to settle payments. And given that you don't have much renminbi liquidity offshore, and for the arguments I made, it's not quite a trusted currency, the renminbi hasn't gotten as much traction as you might expect. And then there are other technologies like stable coins that are getting traction in international payments. And the one interesting thing to note, of course, is that while stable coins are becoming more prevalent, it's one particular type of stable coin that is getting traction, and that is dollar-backed stable coins. So if those start playing a much greater role in international payments, then sort of indirectly the dollar becomes even more dominant, because that is what is backing the stable coins that are being used for international payments. So while technology we thought might shift at least payments away from the dominance of the dollar, it turns out that there are other technological forces at play that might have quite the opposite effect.
Earlier this year, people were talking about Sell America. It was with the dollar. It was also with bonds. People were saying that there's actually going to be a much higher risk premium on longer-term treasuries as a result of some of the U.S.'s trade practices. And here we are, bond yields in the 10-year down below 4%, and there's a feeling that it's the new haven amid some uncertainty around credit skirmishes as well as just global uncertainty. Are we seeing sort of the turning point where we're leaving behind some of the stories of last year and earlier this year about Sell America?
Lisa, as you were discussing earlier, narratives are very compelling, and there was a very clear, logical, and compelling narrative for dollar dominance declining. Because the world wants to de-risk from the dollar, the U.S. now presents a variety of economic as well as geopolitical risk for anybody who wants to hold dollar assets. But the problem now is that there is a lot of turmoil in the world, some of that being created by the United States itself, but a lot of geopolitical flashpoints. In addition, there is a lot of financial market uncertainty around the world as well. Certainly, financial markets have been doing well, but there is a sense of underlying fragility. So that leads investors around the world to search for a safe place to put their money. In addition, many central banks also want protection, and China's central bank, the People's Bank of China, certainly doesn't want the renminbi to appreciate too much, so it's been accumulating reserves as well. When you're accumulating reserves in large quantities, the reality is that you look for a safe place to put your money that also provides liquidity and some other attributes. There isn't any other place to hide other than the US dollar. So in fact, for all the talk of de-risking from the dollar, over the last 12 months, foreign investors have actually bought about $650 billion worth of US Treasury securities, of which about $70 billion has been by foreign central banks. So the world desperately wants to diversify away from the dollar, de-risk from the dollar, but there really isn't much other place to hide.
Eswar, I hear you on China, and they're still one of the biggest holders of U.S. debt, but they've been slowly trimming their holdings over the past decade, and they're buying more gold. So doesn't that show that China in itself is trying to remove itself a little bit more from a dependence on the dollar when they put their money into gold and trim some debt holdings?
It's the People's Bank of China. It's practically every other central bank, Annmarie, that want to diversify away from the dollar. And they have been diversifying at the margin. You know, China's central bank, India's central bank, and others have been buying gold. So at the margin, we're beginning to see some diversification. But this notion of China dumping its U.S. treasuries is really oversold. Brad Setzer had an interesting piece in the Financial Times a couple of days ago making the point that, in fact, rather than the PBOC holding the reserves, some of those have been shifted onto the books of commercial banks that now hold those reserves instead. My view is that in addition to that, we have a lot of rerouting of Chinese holdings of U.S. treasuries through custodial accounts in other countries. So, for instance, over the last year, while China seems to have been trimming its holdings of treasuries, countries like Belgium, Canada, the Cayman Islands, the United Kingdom, all seem to be buying a ton of treasuries. Why? No logical reason really, other than that China is probably running its treasuries through custodial accounts in those countries. So I think China really wants to drive home this narrative that the dollar is in a decline and is doing everything cosmetically to make that happen. Substantively, I think the change is modest at best.
Professor, a clinic, as always. Appreciate your time, sir. Eswar Prasad there of the Brookings Institution and the author of Doom Loop, Why the World Economic Order is Spiraling into Disorder. In the New York Times, that piece only a few few days old. Check it out if you can. You've got a narrative and then you've got the data. Here's the data from that piece. The dollar share of global payments has been stable. On treasuries, foreign holdings of treasuries are increasing, not falling.
And that's basically what you're seeing this, in terms of the bid into bonds in the United States, but that's also the reason why you've seen some stability in the dollar, despite all of the short positions that are out there.
Big difference between the narrative and the data right now, that's for sure. Let's give an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. U.S. and Iranian officials agreeing to continue talks as soon as next week. Iran's foreign minister saying technical teams will meet in Vienna Monday and political talks will resume later in the week. Iran says it won't allow its highly enriched uranium to be moved out of the country, while U.S. officials are signaling Iran needs to send such stocks to another nation or dilute them. Pakistan declaring open war with Afghanistan after cross-border attacks were reported in Kabul and along the shared border. Pakistan has been pressing Taliban authorities in Kabul to halt what it says are attacks by Afghan forces and Pakistani Taliban based across the border. And we are seeing shares of Dell surging more than 10% in the pre-market after the company projected $50 billion in sales of AI servers for the year, well ahead of expectations. Dell's chief operating officer saying the AI opportunity is transforming our company. The company also announcing a $10 billion increase in its share buyback program. That's your Bloomberg Brief. John.
Yahara, thank you. Thanks for the update. Up next on the program, weighing the impact of AI.
Demand for labor in certain occupations has declined, most notably for coders, a field where AI has made significant advances. We do not yet know the exact evolution of this labor market transition, nor its intensity.
Up next, we'll catch up with Krishna Guha of Evercore, live from New York City. You're watching Bloomberg TV. From New York, welcome to the program. Here are your scores. Equities this morning down. A bit of risk aversion out there. We're negative 0.5 on the S&P, down by 1% on the Russell. Pockets of stress in fixed income. Benefiting from that, the 10-year bond yield breaking below 4%, 398 and down 2 basis points on the session.
And it's notable that it comes along with the questions over the British financial collapse and the loans tied to that. It's also interesting that it comes amid a repricing in private credit loans tied to software. You are seeing in public credit markets, not stress, but on the margins, you're seeing spreads, the extra yield over benchmark rates climb to the highest rates since late last year in both investment grade and high yield.
Spreads are wider, yields are lower, but down 2 basis points on the session so far. Under surveillance this morning, we need to talk about the labour market, weighing the impact of AI.
Demand for labor in certain occupations has declined, most notably for coders, a field where AI has made significant advances. We do not yet know the exact evolution of this labor market transition, nor its intensity. Our normal demand-side monetary policy may not be able to ameliorate an AI-caused unemployment spell without also increasing inflationary pressure.
So here's the latest this morning. Federal Reserve officials preparing for the possibility of further job losses due to artificial intelligence. Block slashing nearly half of its staff in a big bet on tech productivity. Krishna Guha of Evercore writing, Fed Governor Lisa Cook raises the possibility that AI could raise the natural rate of unemployment. We think this could happen further down the line. Krishna joins us now for more. Krishna, welcome. How do you view Block's decision to slash almost half of its staff, and what would you tell clients is behind that this morning?
Well, look, I'm a macroeconomist, not a technologist, but I have to tell you, the technology is clearly moving so fast, and its impact on business models, certainly in software and adjacent spaces, is moving faster, I think, than anyone had contemplated even just a few months ago. And of course, that's then leading the market to wonder, well, what's next, and raising questions about other business models too. The issue, of course, is how are we doing in the horse race between AI wealth creation and wealth destruction, and AI job creation and job destruction?
And it seems like right now, nobody really has the answer about how long it's going to take before those two come together. I've been struck by how the Fed has responded to it. Lisa Cook, John was just mentioning, the Fed governor, who talked about how maybe it's not the Fed's responsibility to respond to any kind of AI-led disruption. Does any kind of job displacement lead the Fed to cut rates, to hold rates? How does it affect policy?
So I think we want to bring a kind of nuanced approach to that question. First up, in the here and now, our assessment is that we're still not seeing massive structural economy-wide job location from AI, and we may well not see that, for instance, on a 26 horizon. So we don't think that this is going to be a very major driver of unemployment dynamics this year. We do think is happening right now, though, is that the AI shock and the fears of those job dislocations down the line are changing the bargaining power between employer and employee, giving us muted wage growth and therefore muted underlying inflation pressures. What Lisa Cook is talking about is what happens a little further down the pike if and when you get major economy-wide structural dislocations out of AI. She's making the point that you can't rely on monetary policy to fix all those issues. That would likely be associated in that later phase with an increase in structural skills mismatches, structural unemployment. And I think Cook is saying quite rightly, listen, we're going to need thoughtful labor market policies, retraining policies, skills policies, income transfer policies, things that lie well outside the Federal Reserve's remit. Does that mean the Fed would sit on its hands if unemployment rose a lot due to AI? No.
Is your sense, Krishna, that the bond market right now, given the fact that yields at the lowest levels of the year, are signaling that inflation is no longer a problem, and that if anything, that a lot of the technology is going to prove to be disinflationary, even in the short term?
So I do have sympathy in that direction, yes. I mean, as you know well, it's always a little hard to parse out the sort of short-run safe haven aspect of this, people hiding out in bonds in effect, when the market is going through this phase of really focusing on AI losers. No one's quite sure how far that could go. So you have this sort of temporary hiding out, hedging that risk of a deeper stock market sell-off into bonds. But I think behind that, you are seeing, I think, the bond market take the view that in spite of the cyclical upturn, in spite of, one big beautiful bill, fiscal stimulus this year, in spite of the benefit of Fed rate cuts late last year, it's actually looking like the medium-term inflation risks, maybe more to the downside than the upside, because of the impact of AI on inflation.
Interesting. Krishna, thanks for your time, sir. As always, one of the clearest thinkers in economics. Krishna Guha there of Evercore, economist turned technologist. And we all have to, right? We all have to have a little look at what's happening.
There is no choice, because if you're not, then an AI bot will probably take your job and become an economist and also a technologist. But the idea that right now in the near term you're seeing more of the disinflationary forces being reflected in markets highlights how important it is to get the gut check from things like the PPI in just an hour and a half time, which we're very excited about.
And when it comes to policymakers, we're going to see Congress really push for this. There's a report out today that one congressman or senator is looking to an automatic whole of government response if unemployment exceeds 5.5% because of AI.
Yields down this morning by 2 basis points. It's a break of 4% on 10s. Up next, we'll catch up with Victoria Fernandez of Crossmark Global, Gregory Allen of CSIS, the former White House senior advisor Amos Hochstein, and Mark Lehmann of Citizens Bank from New York City. The second hour of Bloomberg Surveillance. Up next.
There are many cross currents affecting the U.S. economy this year.
Inflation's been remarkably stable.
There are some headwinds for inflation that can keep it elevated.
The Fed is not going forward with an easing bias.
If you were to see unemployment go up in a significant way, they'll cut rates.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It is the longest Q1 ever, and you've still got another month of it to go. From New York City this morning, good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Futures declining by 0.5% on the S&P, on the Nasdaq down by a similar amount. On the Russell, down by 1 percentage point. The big stock mover to watch in the pre-market, it's Jack Dorsey's Block. That stock is absolutely surging as Block looks to cut almost half of its labor force.
And doesn't just want to cut half of its labor force, but also is suggesting that it's artificial intelligence that is allowing it to do so. The big discussion right now is how much is actually because of AI coming up with new capabilities that can allow them to cut. Is this truly a template for other companies, or is this a bloated firm that is looking to trim around the edges and get a more than 18% pop in one day?
What a rally in the pre-market. We caught up with an analyst from Mizuho a little bit earlier on this morning. Which one is it? Post-pandemic bloat? Is this the real deal? Can you do a whole lot more with less? He was unsure and unconvinced, I think, also by Jack Dorsey on the call just yesterday.
Right, and Jack Dorsey right now is taking to Twitter over the past few hours and actually responding to individuals who are being critical of this move and saying, isn't it just because you overhired during the pandemic? Bloomberg Intelligence went through some of the numbers, and they basically say that this move can generate up to $1 billion in cost savings. And not only has stock been pretty bad last year, down more than 10%. The past 5 years, it's down more than 70%. So when you look at the stock price, it feels like this was desperately needed.
John asked a really great question earlier. What are they using the extra cash for? Are they using it just to do returns to their shareholders, or are they actually going to be expanding? This is the key question, I think, going forward, because ultimately, if you can have cost savings and you have imagination and ambition, you should be able to deploy it into new ideas and expanding a business that actually would require more personnel. At what point do you start to see the winners doing things like that, not necessarily just doing mass layoffs and saying, look at us, we can get rid of everybody?
A lot of questions we need to have answered here, but ultimately a stock move like that, it's going to be a big green light for a lot of C-suites to think about doing the same thing. Check this out in the bond market. Need to stay on top of this story. Yields down across the curve, 10's grinding lower. It's a break of 4% on a 10-year bond yield, down by 2 basis points on a session, 3.98. Yields just chopping lower. For all the reasons we've been talking about, a better economy and yields should be higher, and here we are, sub 4%.
And so give your own narrative to it. Right now, you do have, of course, some anxiety percolating in private credit markets. You've seen that in a significant way. Yesterday, Apollo cut dividends on a number of a couple of their funds. There's a question here about the market financial solutions over in the UK. There's anxiety about what you're going to do if you lose your job to a bot. How much is that going to really affect things? And all of that is leading to this rally. Does it also suggest what Krishna Guha was just saying, which is in the near term, AI deployment will be disinflationary much more quickly than people previously thought?
It's a fascinating story. 398.49 on 10s right now. Coming up this hour, we'll catch up with Victoria Fernandez of Crossmark as equities look to find their footing. Gregory Allen of CSIS joins us as Anthropic rejects the Pentagon's AI demands, and Mark Lehmann of Citizens as markets face more tech losses. We begin this hour with stocks lower following a tech sell-off. Victoria Fernandez of Crossmark Global writing, there is a large moat between semis and software, and we would expect to see this gap narrow over the coming months. Victoria joins us now for more. Victoria, before we start with the stock market, I want to turn to fixed income. Yields breaking below 4% on 10s at a time where people are speaking to us and telling us their outlook for the economy is still pretty good, and we could see a bounce in the year ahead. Why is that not being confirmed by this yield curve?
Yeah, I think when we're looking at yields right now, people are looking more around safe haven. They're concerned about what's going on, not just in geopolitics, but in terms of domestically, the growth concerns that we have, all of the elements that you guys were talking about in terms of the labor market. So you're seeing a little bit of a flight to safety, some safe haven concerns, but you're also seeing a Fed that is being more hawkish than what people had anticipated. Perhaps you're getting a little bit of rate cuts priced out of this market. So you're seeing the short end come up and the long end come down on that. And maybe bond vigilantes are saying, wait a minute, we don't need to go out and be as vocal as we were before, because we don't think we're going to see some of the same issues pressuring inflation higher that they thought they were before. Maybe that's because of tariffs. That's a little bit of effect. We have seen near-term inflation expectations go up a little bit, but real yields have come down. So they kind of offset each other. I think all of these things together are giving you a flatter yield curve right now. But when we look out through the rest of the year, I would expect to see that steepen over the coming quarters.
So, Victoria, that's not happening right now. So I've got a question about fixed income more broadly. Lisa mentioned it. There's stress in equities, and we'll spend some time on that. But there's also stress in pockets of fixed income, particularly in private markets. Is any of that contributing to this move in yields lower?
I think definitely there is. There's, a lot of people just look at fixed income and they say, oh, there's no way you can lose money here, right? It's that guaranteed component. Well, it's not. And even though the credit market seems to be holding its own somewhat, when you look at investment grade, you're only seeing moderate widening on some of the high yield components. This private credit component that has grown immensely over the last couple of years as people have moved outside traditional bank financing, finding other areas to put money to work that doesn't have the same regulations that banks do. As we've seen that grow, it's become a larger and larger part of the credit market. And now you're starting to see some concerns around that. Maybe the lack of regulations there have not been such a positive thing. That again leads to this flight to safety in terms of treasuries, in terms of things that people do feel a lot more comfortable with. And it's causing some consternation in the market. When the market gets uncertain, when the market gets nervous, we see yields come lower. We see the yield curve flatten. And I think that's part of what you're seeing here.
Victoria, just to take this a step further, earlier this year, we were noting that even as you saw this violent rotation under the surface and a lot of fear in equity markets, you weren't seeing any kind of response in the fixed income market. There was a sanguine look at all of this and saying that the economy will just chug along. In the past couple of weeks, that's shifted. And you talked about spreads widening, high yield bond yields, and the public markets are at the widest going back to November. If you do believe that bond markets are sort of a smarter tell, and I'm not saying that they are, do you think that this foretells a greater degree of drawdown or pain in public equity markets?
I think it definitely tells you that you need to be careful and more cautious in where you're putting your money to work, because there is the opportunity to see the equity market come down. We know before the equity market would start to get nervous when yields would get around 450. Now we're seeing the actual opposite effect. Wait, yields are coming down too low now. And that means there's concern around growth. There's concern around the economy. So again, it's a warning sign for a lot of investors that, wait, we could see some churn in the equity market. And then a midterm election year, you typically see a high teens pullback anyway around the middle of the year. So you take that and you add to it some of the excessiveness that we've seen in the equity market, bull-bear ratios at extreme highs. We're seeing leverage funds with net short positions at extreme levels. You're seeing some things that cause consternation. And so, yes, I think the credit market right now is telling you, or it's flashing a warning sign saying, look, things may not be as good as everyone was hoping they would be, as good as things have been priced into this market. So you need to be careful in where you're putting money to work.
Given that, is it time to question the equal weight rotation that we've seen really gain steam? Our colleague Dan Curtis pointed to a chart this morning showing that the equal weight has had its biggest outperformance so far this year, going back to 2009 versus the market weight. I mean, is that sort of done? Do you sort of go against that for the remainder of this year?
I don't know if I would go against it quite yet, Lisa. And obviously, equal weight is doing great. It hit a new high this week. So there is this component of broadening out in the equity market that is actually quite positive. I think it's one of the tailwinds that tells you the bull market that we've been in can probably continue a little bit longer because of that broadening out. We want to see it in earnings as well. You don't just want to see it in where people are putting their money in the market, but the fact that they're not pulling money out of the market and going to cash like we've seen in other times, that tells us that people are still pretty optimistic about what can happen outside of tech. And so that broadening out is a positive sign, and it's a tailwind for the market. I wouldn't bet against it, but I also would be quite cautious in looking at some of those areas that now have been overbought. Staples are overbought right now. I wouldn't chase that. I would look for some of the other areas where you're seeing uptrends, where you're seeing that start to turn. Relative performance is doing well, but don't go after some of those areas that have gotten really hot. You don't want to chase it here.
Well, Victoria, could the broadening out continue if the Fed remains on hold for longer?
I think it can continue, but we've had so much of it happen already that I don't think there's going to be any huge surprises from this point in time. You actually even look within tech, semis versus software, kind of coming to the quote that Jonathan read in the very beginning, this big moat that you've had there. Well, you're already starting to see that compress. Semis are actually weakening internally, and you've seen software. Look at yesterday, software got a little bit of a boost. So that moat is starting to decline a little bit there. So yes, the broadening is there. I think it will continue. Even if the Fed stays on hold, I think people say, where is there an opportunity for me here outside of some of these high priced areas that we've seen? PEs coming down in some areas, they're going quite high in others. So you do have to be cautious. But I think the Fed on hold says, wait a minute, the economy is going to be okay. So we don't need to come out and go to cash. Let's look to see where opportunities lie.
Victoria, always good to catch up, to get your thoughts on this market. Victoria Fernandez there of Crossmark Global Investments. Coming into the year, you can see why people were bullish on the economy. Just had some rate cuts, about to get some tax refunds, lots of capex. Got it. There are some pieces of the puzzle missing. The cyclical rotation of people positioned for. Discretionary's underperformed. Seen it on the month, seen it on the year. Staples have absolutely ripped. Banks have started to struggle. Saw that January through February, just this burst of risk aversion that's holding back some of those names. And you pair that with a fixed income move, 25 basis point move lower on a 10-year bond yield. That doesn't scream economic growth.
Nobody's really contemplating runaway inflation except for maybe Torsten Slok over at Apollo who's talking about rate hikes. Otherwise, people are saying, well, you know, Neil Dutta pointing to even refunds, tax refunds, and saying that they're somewhat underwhelming so far. The one big beautiful bill, how much has that already been accounted for? And then you look at some of the spending and frankly, holiday sales, not as exciting as people previously thought.
You may end up getting a tariff dividend though in a backwards kind of way. FedEx statement yesterday saying any refund they get, they will push out to the consumers that had to pay more. Maybe in a way, we're going to get a FedEx dividend. Maybe we can call it that.
Trade QE. Fantastic. Can't wait. Is that what's driving yields lower? No, I'm not going there. Futures negative this morning by about 0.5% on the S&P 500. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. We're seeing shares of CoreWeave falling 11.5% in the pre-market after the AI data center operator reported a bigger loss than expected. CoreWeave also boosting CapEx, sparking concerns it might be overspending on infrastructure. The company ramping up borrowing in recent years amid an industry-wide debt binge that has unsettled investors. Meanwhile, shares of Block surging in the pre-market. The company announcing it's cutting its workforce by nearly half, or 4,000 employees. CEO Jack Dorsey saying AI is changing the future of labor productivity, adding, "I don't think we're early to this realization. I think most companies are late. Within the next year, the majority of companies will make similar structural changes." Shares up 20%. And former President Bill Clinton will testify before Congress today about his relationship with convicted sex offender, the late Jeffrey Epstein. His wife, former Secretary of State Hillary Clinton, denied any association with Epstein during an hours-long deposition yesterday. Clinton told reporters she is confident her husband knew nothing about Epstein's crimes. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. This year's moving so quickly. At the same time, it's moving so slow. The fact that we're having all this news and it feels like a lifetime ago that Maduro was taken out of Caracas. Never mind a week ago that AIPA was struck down by the Supreme Court. And going into that, people thought the yields would climb if that decision was ultimately made, which is why I bring up the trade story and where yields are. To see bonds south of 4%, even with all of this stuff going on, pretty remarkable.
I'm old enough to remember when we had a big snowstorm. Now the snow's melted. I mean, honestly, it is just shocking. I mean, right now, though, the bond market, absolutely not rejected. I think that bond markets are telling us something, and we have to
You pretend you didn't hear that?
100%.
Has it snowed again this weekend?
I saw a tweet about potentially snow this weekend. I'll get you a full update after commercial break.
Okay, weather report coming up later.
Doppler.
Annmarie, there we go. Up next on the program, the AI ultimatum.
Now we're totally leading the AI race. America is the country that started the AI race. I'm here today to declare that America is going to win it.
Up next, we'll catch up with Gregory Allen of CSIS from New York City this morning. Good morning. Futures negative here. We're down by 0.4% on the S&P. On the Nasdaq, a similar move on the Russell. The small caps underperforming. We're down by 0.9% so far this Friday morning. Under surveillance this morning, the AI ultimatum.
Now we're totally leading the AI race and the artificial intelligence. It's a big deal. We also know that a big part of our economy, it could be 50, 60% of our economy going forward for a period of time at least. America is the country that started the AI race, And as President of the United States, I'm here today to declare that America is going to win it.
So here's the latest this morning. The standoff between Anthropic and the Pentagon over AI military safeguards is ramping up. The tech giant is facing a deadline today to accept conditions or be blacklisted. The Anthropic CEO, Dario Amodei, saying in a statement, quote, "These threats do not change our position. We cannot in good conscience accede to their request." The Undersecretary of Defense, Emil, responding, calling Amodei a liar with a God complex. Bloomberg's Tyler Kendall joins us now for more. Tyler, so these negotiations are going really well.
Well, John, I think that's probably an understatement here. This is a huge escalation as we fast approach tonight's 5:01 p.m. Eastern deadline. We heard from Anthropic saying that the Pentagon has made, quote, virtually no progress on its demands for safeguards in exchange for the military using its AI tools. Those demands include prohibition on the use of its tech for, 1, mass surveillance of Americans, and 2, in fully autonomous weapons. The thing is, the Pentagon says that it doesn't want to use the technology in these ways, that it will comply with federal law, and that it just doesn't want these predetermined limits. In fact, we heard in one statement from a Pentagon spokesperson yesterday on X saying that the department wouldn't let any company determine anything related to, quote, operational decisions. The Pentagon has now put 2 major threats on the table if Anthropic doesn't comply. The first is that it could deem the company a supply chain risk. That would essentially make Anthropic's products off limits to other military contractors. This is something that is typically done for those companies that have been deemed U.S. adversaries. The second threat on the table is that the administration could invoke the Defense Production Act, which would essentially compel Anthropic to deliver its products on national security concerns. And the company has pointed out how these threats are perhaps a little contradictory. One would block its products while the other would mandate it. And there are already legal questions that are starting to swirl, particularly on Capitol Hill. John, this is really underscoring the tensions between the private sector and the administration when it comes to the tech space, but also increased competition. It is our understanding that negotiations are accelerating between the Pentagon and some other top AI companies like OpenAI and Google for the administration to use their tech instead when it comes to classified settings.
Tyler Kendall down in Washington. Tyler, thank you. Just a quick programming note. Exclusive conversation coming up a little bit later on this morning. Exclusive, I should say. The Undersecretary of Defense, Emil, joining the programme at 8:15 Eastern Time. A lot of questions for him, and I appreciate him giving us some time because I think we're all open-minded about what's happening here. We just want to know what's actually happening.
Yeah, and he's in the middle, obviously, of these negotiations with Anthropic, and his Twitter feed last night was absolutely on fire. And it didn't just stop there with that tweet saying that Dario has a God complex. So this is going to be incredibly interesting because the deadline is this evening when it comes to Anthropic and the DoD.
That conversation about an hour away. Check that out right here on Bloomberg Surveillance. Gregory Allen, the former official at the Defense Department's Joint Artificial Intelligence Center, writing, threatening to designate Anthropic as a supply chain risk is a hugely disproportionate and unnecessary escalation. Gregory joins us now for more. Gregory, welcome to the program. Can you share with us how you think we got to this place? How did we get here?
Well, this is a remarkable evolution from where we were only a few years ago. I remember in the summer of 2018 when Google, under employee protests, pulled out of Project Maven, which was at the time the DoD's flagship AI initiative. And ever since then, the DoD has been trying to rebuild relationships with leading AI companies in the American technology industry. And now where are we? One of the leading AI companies in the world is deeply embedded in many different aspects of U.S. national security across military operations and intelligence operations. Anthropic is used in Project Maven, as disclosed by my former boss, Lieutenant General Jack Shanahan, and getting really positive reviews from the user communities in both the military and the intelligence community. This contract represents, in my perspective, victory, and victory even from the perspective of this Trump White House. After all, they were the ones who were requesting less restrictive contract terms after they agreed to a much more restrictive set of contract terms back in July 2025. But now this Department of Defense has taken an absolutist stance, saying that they want no restrictions whatsoever, including on items like domestic mass surveillance and the use of AI-enabled lethal autonomous weapons without any human oversight. My advice to the Department of Defense here is take the win. You've said you don't want to do these applications after all. There is no reason to go to their two purported escalations of designating Anthropic as a supply chain risk or invoking the Defense Production Act. Either of those would do long-term damage to the relationship between the Pentagon and Silicon Valley, something that has been very hard to repair, and we are on much stronger ground if we don't go there.
Greg, when you say the DoD should just take the win, and you have Anthropic having these two red lines, does that just show that the DoD does not want any red lines at all when it comes to using any sort of AI tools?
Yes, this is the key to understand here. When the DoD says it cannot accept any contractual restrictions, they already did accept contractual restrictions in July 2025. And by talking with Anthropic about what they wanted to do and the conditions under which they wanted to do it, Anthropic has already walked away from the vast majority of those contractual restrictions. For example, using their technology in offensive cyber operations. And according to reporting by the Wall Street Journal, Anthropic's technology was instrumental in the operation against Venezuela that captured former Venezuelan President Nicolas Maduro. This technology has worked. Anthropic has proven itself to be a reliable partner, and they're a reasonable partner who don't just arbitrarily draw red lines under no consideration. To give you one example, in Dario's note last night, he said that he's not inherently opposed to autonomous weapons. In fact, the contractual terms that he's requesting would even allow Anthropic's technology to be used in the development of such weapons. The red line, as they've drawn it, is merely around the use of such weapons without human oversight. And even there, Anthropic is saying that this is not a never type of red line. This is simply a not now based on the current level of the maturity of the technology. The absolutist terms and the escalation that the DoD is going for is completely unnecessary in this situation.
I'm glad you mentioned Nicolas Maduro. Is that what kicked off this latest feud between Anthropic and the Department of Defense?
No, I don't believe so. What kicked off it was the Department of War's AI strategy, which specifically said that they were no longer interested in having contractual restrictions with any of their contractors. And to be honest here, I'm sympathetic to the Department of Defense's position. They want the operational flexibility to say we need to be able to decide how we use our technologies. If you think about history, for example, in the Korean War, it was actually a decisive moment when the Department of Defense decided to introduce a new class of jet engine fighters before they were deemed ready. That saved a lot of lives in the Korean War because they were willing to accept that operational technology risk. So I'm sympathetic to their point that they need flexibility. They need to be able to ones to decide these terms.
Hey, Gregory.
But here's the thing. In talking with Department of Defense officials, I've heard of no one who's encountering challenges with these restrictions thus far.
Got to jump in, sir, because we're against the clock. It's good to hear from you. Fantastic. Gregory Allen there of CSIS. Two conditions that Anthropic wants. Doesn't want its tech used for surveillance of US citizens or for autonomous lethal strikes without a human in the loop. Two conditions. The problem the Department of War has got now, and I'm looking forward to catching up with the government to get their view, is this has spilled out into the court of public opinion. And when you put those two things in front of the court of the public right now, they'd say that sounds pretty reasonable.
How do you give those conditions if that isn't something that you have planned? And that's part of the problem in even having this discussion.
Up next on the programme, the former White House senior advisor Amos Hochstein with more US-Iran nuclear talks on deck. That conversation moments away. Futures this morning negative by 0.4% on the S&P. Likewise on the Nasdaq. On the Russell, we're down by 0.9. What has happened to the so-called cyclical rotation at the index level, but also at the sector level as well? The underperformance of discretionary versus staples. What we've seen with the banks struggling January through February. You're not seeing it reflected at the sector level either. Consumer discretionary over the past 30 days really struggling, down by about 6%. You see this also in the bond market. This is where it gets interesting. 10s, sub 4%. So far this morning, 398 and down by 2 basis points. This from Chris Harvey of CIBC. Risk is repricing as expected. That's healthy, but the widening of credit spreads suggests the process isn't over, and there is a growing probability the situation becomes fluid.
Right now, we're seeing high-yield bond spreads and investment-grade bond spreads widen to the highs of this year in tandem with that bid into treasuries, which raises the question, are we starting to see stress? It is only magnified by what we're seeing in pockets of the private credit markets and public sentiment. I mean, how much do you could be watching some of the data coming out, especially that labor market report next week, to give you a sentiment read as we all doom scroll through these substacks?
It's not just the long end, though. Front end of the curve, too. Two's back to 340 this morning.
Even though the Fed has come out with some less than dovish prognostications, the data will overwhelm them, and that's what everyone seems to say. And right now, frankly, I keep going back to what Krishna Guha said. The feeling in markets is that AI will be disinflationary, not only in the long term, but potentially even in the short term.
Yields down across the curve this morning, down 2 to 3 at the front end, on 10s down by about 2 to 398. As we count you down to the opening bout, 2 hours away, let's get you some single names, some morning movers. Danny has more. Hey, Danny.
Hey, John. The remarkable turn in the Warner Brothers Discovery saga. Netflix bowing out, allowing Paramount with their newly re-upped bid to be the acquirer. Netflix from that gets that $2.8 billion breakup fee. They can probably make a nice few movies off of that. So what do you get? A surge in Netflix price shares. Investors are happy, as they are for Paramount. Shares go up 7.3%, and Warner Brothers drops, maybe because the bidding war is now over. The other story, which you all have been tracking very closely, is Block laying off about 40% of their employees, going from 10,000 to 6,000, saying it's because of AI efficiencies. Again, you all have been excellent on this. Is this the green light for the rest of the companies? Because of this move, a 20% surge in share prices of Block. Finally, Dell's success at that company, not because of the hardware. We know some of the memory chip costs have been weighing on this company. Instead, it's the demand for their AI servers allows them to have a really strong earnings report. So those shares up 12.33%, John.
Danny, thanks for the update. Danny Berger there. She's going to lead you through to the opening bout a little bit later this morning alongside Matt Miller. On our radar this morning, Block shares rising in the pre-market after announcing it will cut nearly half of its staff. The CEO, Jack Dorsey, describing the move as a bet on artificial intelligence changing the future of labour productivity. Elsewhere, FedEx saying it will return potential tariff refunds to shippers and customers who paid them. The company filing a suit in the US Court of International Trade to recoup levies paid before the Supreme Court struck down President Trump's emergency tariffs. And finally, check this one out. The New York City Mayor Zohran Mamdani visiting the White House, looking to secure $21 billion in federal grants for a new housing program. Mamdani gifting President Trump with a mock Daily News cover reading, quote, "Trump to the city, let's build."
These two are very strange bedfellows and also somewhat logical bedfellows, considering a more populist tilt for both of them. And clearly, Zohran Mamdani is really focused on using the housing push to really ignite some sort of coming together of these two minds who would be polar opposites, at least in the political spectrum. Look, it's the path of travel. I mean, you could talk about the romance that's emerging here. Or is it just them mocking each other?
I'd rather not talk about the romance at all,
actually. But I actually, you don't want to talk about that?
No, not
we can
really.
do that if you want to, but we can go forward further and talk about how this is sort of the path of travel in terms of populist policies.
It is know your audience. Two guys from Queens. He is a real estate developer from New York, going with a housing pitch that Trump could also really want to get on board of when it comes to New York City. So I think it makes perfect sense. And he brought a prop. This isn't Gerald Ford. He brought a prop saying, look what you could be on the Daily News in the future. So for Mamdani, he read the room carefully.
He's so good at this, and not on policy, don't like his policy, but he's so good at the politics, to understand what the president wants to hear, to understand the marketing and the TV moment to capture a picture like that.
Totally.
When I saw that photo yesterday on X, I thought it was fake.
Same.
And I thought it was from a parody account.
I called someone, said, is this real?
Because of the quality of the photo, was a bit off, but I thought it was fake. I didn't think it was real. And the fact that they managed to get together and do that, the guy on the left is so good at the politics, and the guy on the right appreciates the moment like this, and that's what they've got in common.
Two men who are both born and bred in New York City and really love celebrity. Well, they are made for each other, and right now that's definitely what you're seeing.
Absolutely. And to your original point, this is the power of populism. You have seen policies from Trump move to what we've heard from, say, Elizabeth Warren, from Bernie Sanders, and now Zohran Mamdani.
The mayor of New York and the president of the United States. Let's turn to this story. US and Iranian officials agreeing to another round of nuclear talks next week in Vienna after wrapping up negotiations in Geneva. A person familiar with the US position saying Americans were disappointed with the progress of talks. Amos Hochstein, the managing partner at TWG Global and former senior White House senior advisor, joins us now for more. Hello, sir. It's good to see you.
It's great to be here with you.
Amos, what moment are we in right now? How tense are these negotiations?
Well, the moment that we're in is very serious, as the president said, because I think that we're gearing and rolling towards a war that I'm not even sure the president wants to do, but yet the momentum is in that direction. As far as the negotiations, I'm still not sure if these negotiations are for real. I think they began as a sham negotiation, meaning we weren't ready. The president went off script and promised action in Iran and got himself stuck in am I going to be like Obama with a red line or not with the protesters? And so suddenly there was this momentum towards go to war, but you then realize, well, I don't have the forces actually on the ground in the region to do anything because I moved them all out to go to Venezuela. So now I got to get more forces and I need more time. The Gulf is split between those who really want to go to war and those who are very, very concerned about it because they think it's not going to go well. So he gets the mixed messaging from the Gulf. The Israelis are pushing him to do it, obviously. And so the buildup starts, and he needs to be able to tell the Europeans and the Middle East folks, look, I tried to do a negotiation. If we go to war, he has to be able to check a box that says, it wasn't my first option. I tried, the Iranians screwed up. He's aided by the fact that the Iranians always rise to the moment to screw up every situation that you're in. They literally mess everything up. They have no idea what the world is like. They live in some wacko bubble of threatening U.S. forces when they're trying to do a negotiation.
How difficult is it to negotiate with the Iranians?
Well, it's not even direct negotiations. They have this ridiculous theater of we can't sit face to face, and we do it through the Omanis, despite the fact 10 years ago they sat face to face for months with Wendy Sherman and John Kerry and so on. And it's the same people, by the way. It's Arachi, who was then the deputy. So it's very complicated. I think the Iranian system is going through a moment where the supreme leader is the crazy old man who throws out tweets that mess up what everybody else in the Iranian system is doing because he's disconnected from the system.
Well, it's existential for the Iranian regime, which is why the question for them is, would it be better to have a deal at the negotiating table or to shore up their place in Iranian society? Is it better almost for the U.S. to strike them?
Look, the distance between the Iranian society and the government has never been bigger. I mean, these people just massacred. I don't know if the numbers are floating around, but horrific. Thousands of people were killed by their own government, which is not missiles, not nuclear. That's the impetus for this war, right? Remember, we did not talk about missiles or nuclear as the reason to go to this conflict because there is no real imminent threat from those two issues, right? They were, quote unquote, obliterated the nuclear program 6 months ago.
But they still have a goal to make a nuclear weapon. Our DNI assessment says they are barreling towards intercontinental ballistic missiles, and they're still funding the proxies around the region. Those are the three red lines of the administration. There's
no doubt the Iranian threat to the region in December and today are the same from that perspective. As the president said, the nuclear program was set back years, not months. And the missile program is the one that is really of concern. But that wasn't what led us here, Annmarie. It was the protesters. Help is on the way. And so now the decision is, what kind of war do you go to? And I think this is a critical point that people are missing. There are three basic options here on this war. Only three. One is a slightly more limited strike that takes out missile depots, missile storage, launchers, and maybe another strike at the nuclear for symbolic purposes. But you leave the regime intact, but weakened. Very weakened. Most of the Gulfies prefer this option. The other one is a much more significant attack, which they have the preparation for at CENTCOM, at Central Command, which is a regime collapse or change. And that's where the two options are. You don't know in advance if you're going to get regime collapse or regime change. Regime change is when you know who comes next and you know that you can figure this out. Think Venezuela and Delcy, right? You know who's coming. Regime collapse is you have no idea. And as one major Gulf country said to me at the leadership level, if they're going, we'd hate the Iranians, but if they end up with Libya, they leave us with Libya next door, that's a real problem for all of us.
Isn't there a third option? And not to put you on the spot, but the Biden administration did nothing when it came to Iran and just dragged on talks for 4 years.
The Biden administration said we're willing to renegotiate going back into the JCPOA that the Trump administration had left, but we're not going to go in as just re-signing the same document. The Iranians did not want to negotiate. Then October 7 happened. Remember, we were doing the normalization with Saudi Arabia. We were really weeks away from that. when October 7 happened. The Iranians then chose to do a 300 projectile attack on Israel from its sovereign territory with the 100 ballistic missiles and 200 UAVs. And they did that attack twice, in April and October of 2024. The United States then gave the green light and talked with the Israelis about taking out the missile defense and weakening the Iranians. The Iranian proxies are weakened across the board. So you can say do nothing, but in reality was continuing the sanctions pressure and not getting into the JCPOA was a major decision. If you go back to the elections of 2020, everybody said, every Middle East expert said, Joe Biden's going to get elected and go right back into the JCPOA. And it did not happen.
Because he put Bob Malley in head of the Iranian affairs.
Maybe, but the person who makes the decision is not Rob Malley. He was the president, and he said no.
I just want to fit this in because we're talking about this and talking about ballistic missiles and a lot of the weaponry of the past, at least as this is very quickly moving. And we're talking about new weapons of war, which include a lot of technologically fused instruments. How does the use of artificial intelligence and the U.S.'s preeminence in that sphere change this discussion and, frankly, change all discussions going forward when it comes to some military negotiations?
So I think this is a key point. When Annmarie's talking about sort of they're building out their missile capacity and so on, Iran is a relic. All right? It's literally a relic. So what if it has a bunch of missiles that we can put some use? We don't want them to have it for sure. We don't want them to give them to the Houthis and to Hezbollah and so on. But when you talk about advanced weaponry, the capability of fusing intelligence superiority with satellite superiority, with AI and drones. The Iranians can do the drones for Russia, but the Russia-Ukraine war is also a relic. The advantages that the United States has, the advantages that Israel has in the region, including total air superiority from Israel all the way to Tehran. This is not really a threat it's a menace, it's a nuisance, it's dangerous, but it's not an existential threat. Its nuclear program would be. And every president of the United States, every single one, Democrat and Republican, has said we will not allow them to have a nuclear program, which is why I supported what President Trump did by attacking those sites. If you're going to keep doing those programs, that's a real threat. But the rest, we're going to an era of such technological advancement, whether or not the Pentagon can get out of its own way with AI. So we should be able, I'm sorry.
What are your thoughts?
I really hope that both the company and the Pentagon can go back to having this conversation in classified settings and in private, and not in front of the whole world. And I also really hope that this is not corporate against corporate playing out in government contracts.
What are you implying?
I'm implying that there's another AI company that may not be so happy with Anthropic getting this kind of advantage by being. Do you think that's
had some influence to bring us to this moment?
I think 12 months ago I would have said no way. I think that watching the last 12 months where the government decides M&As, decides corporate activity, it's not a big leap. And it's understandable. I also understand why corporations would have this kind of a fight at the Pentagon, because the government is the ultimate arbiter now in major corporate decisions, right? Not on every one, but on major ones. If you're going to buy a news channel or not, it's the White House that decides who gets to own it or not. So it's not that big of a leap to say if the president and the White House decides who does major M&A. Why is it such a big leap to think this is not exactly about Pentagon versus Anthropic? Anthropic and the government seem not to be that far when it comes to what their requirements are. So they should have been able to reach a deal. It's just a weird kind of I don't understand this at all.
It's the central planning that the Biden government dreamt about, right?
No, more Bernie Sanders, not.
That was too good.
Amos, it's good to see you.
It's
Thank
good to see you too.
Amos Hochstein there, the managing partner at TWG Global and former White House senior advisor. Let's get you an update on news worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. London's Market Financial Solutions is collapsing, leaving giants like Barclays and Jefferies scrambling to recoup money. The fall echoing recent failures in the U.S., namely Tricolor Holdings, adding to fears global banks are unable to detect massive collateral fraud. The global smartphone market is shrinking. Research firm IDC saying the market will contract nearly 13% this year due to the memory chip shortage. The demand for advanced memory is to power AI tasks is draining global supply, jeopardizing the business model of many smartphone makers. And President Donald Trump tapping Florida Governor Ron DeSantis and New York Yankees President Randy Levine to co-lead a council that will explore ways to overhaul college sports. Sources telling us here at Bloomberg, the commission will discuss a potential antitrust exemption that would protect the NCAA from legal challenges to players' compensation rules. That's your Bloomberg Brief, John.
Yahara, thank you. More from Yahara in the next hour. Up next on the program, AI derangement syndrome.
I think right now the street really more focused about the risks tied to AI.
We've got what I call AI derangement syndrome.
Whether or not there's a bubble, it's disruption. There are going to be winners and losers.
Up next, we'll catch up with Mark Lehmann of Citizens Bank from New York. You're watching Bloomberg TV. Stocks are down this morning, negative by 0.6% on the S&P, on the Russell. The Russell 2000 is down by more than 1 full percentage point. Some risk aversion out there this morning. Tens in the bond market breaking 4%. Under surveillance this morning, AI derangement syndrome.
I think right now the street really more focused about the risks tied to AI, more so than the growth opportunities here long term from AI.
We've got what I call AI derangement syndrome.
Whether or not there's a bubble, it's disruption. There are going to be winners and losers.
We've got to think about how much of a risk there is given this massive wealth concentration in the AI trade.
So here's the latest this morning. The S&P 500 heading towards a February loss following a month of fears linked to the future of AI. Mark Lehmann of Citizens Commercial Bank writing, AI will reshape businesses, but the software sell-off is overdone. Mark joins us now for more. Mark, good morning. Let's get a vibe update from you. East Coast, Wall Street, obsessing, hysteria over Wall Street, over what's happening right now with AI. What's happening on the West Coast at the moment? How do things feel?
There's no less obsession, but you also have a bunch of people who are working in AI, and you have a bunch of people who are watching it happen, and you're seeing the value creation, mostly in the private markets. So there's obviously optimism, tempered with caution about some of the dislocation and SaaS-pocalypse and AI derangement system, terms I've never used before a month ago, but I'm excited.
You've got a ton of people working in software as well.
We do.
That are nervous about their jobs.
Yeah.
And are paid in stock that is getting absolutely hammered at the moment. What are they telling you?
Well, I think they're all worried, rightfully so. I think that's the first thing they talk about in every single meeting, how quickly we can do the adoption. It's happening, obviously, and it's not just the last month. They've been doing this for years. But I think the urgency as well as the problems, if you're not on the front page of this, you're getting in big trouble. And I see it in the stocks, and you do too.
So do you expect this to be the beginning of a trend in terms of what Block did, the idea that you're going to have to shed workers and show efficiencies by curbing some of your human capital?
Yeah, I mean, listen, Block made a really large acquisition that obviously they have to pay for, and they're paying for in their stock. Their stock's down 75% from its all-time high. Obviously, that was a long time ago with rates were a lot lower, but that's the math. I do think it's on the front edge, and they do need to do something dramatic. I think a lot of companies are. I don't know how analogous it was to years ago when we had the same thing with cloud and SaaS and all the things that took place over the last 30 years that I've been on Wall Street. But if you're not doing that right now, you are going to be in the rear, and you're not going to want to have time to catch up.
You know, what's the psychology like for some of these software engineers? Do some of them resist using artificial intelligence because they feel like, we don't want to prove that this actually can do my job, so actually that model is really faulty. Come back to me in 6 months and tell me how it's better.
Yeah, you know, when I got to college, I took a right turn towards accounting and away from the left turn of engineering, but I know enough people who are in that world. I think there are some people who are obviously seeing the trends and are seeing what's happening and saying it's big and it's part of it, but we've been doing it for 10 years. So I don't really know what all the hysteria is. I think they're probably wrong. I think everybody's using it. I mean, even at Citizens, we have this Reimagine the Bank. Everybody is talking about ways to make the culture and make business processes faster. Everybody in every business.
But you're still optimistic on the world.
Well, you know, I always say I'm optimistic because the opposite is so much worse. And things do work out, okay? We were talking earlier today. Nobody looks back and says, boy, investing was so much easier back then, or so much harder back then, it's so easy right now. Or work was so much harder back then, it's so much easier now. Nobody's ever said that. And we're saying it probably accelerating because we talk about adoption curves. This is the fastest adoption curve we've ever seen.
Lisa, take note. You can be optimistic in this environment.
It's the most pessimistic optimism I've ever heard in my life, but carry on.
Going back to Jonathan's original point, though, I would just love for a moment your take on what is going on in California.
Yeah.
There's proposal of a wealth tax. Are you concerned about a brain drain out of that state?
Well, I don't think it's going to pass. I think we've been hearing about a brain drain since 2020. That being said, the amount of venture capital dollars being invested in California is at a record high. All the companies we're talking about on this show, OpenAI, Anthropic, et cetera, are in California. So it's great fodder for headlines. It's great 20 words on Twitter. The facts are the facts. Stanford, as far as I can tell, is not leaving. Vanderbilt is building a brand new engineering campus in San Francisco because they see the talent that's in San Francisco. We have a mayor who's decided to be friendly with business as well as do the things that civic pride and things you need to do for big cities.
Have you got a governor that wants to do the same?
I'm sorry?
Have you got a governor that wants to do the same?
Well, we have a governor who's about to leave. I think he's got designs on something more nationally. And it is the race will, I think, be similar. You're going to have that kind of public-private partnership that we're seeing in California that you need to have. And I think you're going to see that blossom because it's worked in San Francisco.
Last time we caught up, just a quick final question, just on the markets. Last time we caught up, I think you said that the private markets were healthy. What's your assessment of where we are now?
Well, you know, I looked at it from 2000 to 2025. $25 trillion of market cap was created in the public markets between Meta and Google and et cetera, NVIDIA. A lot of that capital has flowed to the private markets. That's where all the growth has become. It's healthy. I think there's some people on the investing side who feel late. I don't think there's anything that's slowing down. The biggest question, frankly, is if you work at one of these companies and you got a big secondary coming up, what are you going to do with your shares? That's the biggest question flowing through, I think, the private markets are very, very healthy.
OK. Mark, it's good to see you.
Thank
you, sir. Thank you. Appreciate the update. Mark Lehmann there of Citizens Bank. Big focus on what's happening in private markets.
And how much that might color the view forward, not only in public credit markets, but also the financing channels for AI.
Big hour coming up. Savita Subramanian of Bank of America joins us. The Undersecretary of Defense, Emil, Alejandra Grindal of Ned Davis, and Ed Al-Hussainy of Columbia Threadneedle. The third hour of Bloomberg Surveillance just around the corner.
I think right now the street really more focused about the risks tied to AI.
We've got what I call AI derangement syndrome.
Right now, everyone's focused on the losers, how AI is going to hurt.
It's just hard to really square this momentum, this sentiment.
We need more diversification away from technology.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores, the price action looks like this. Equity futures on the S&P declining throughout this morning, down by 0.6%. Small caps down by more than 1 full percentage point. In the bond market, 2s, 10s, 30s, yields declining, 10s, sub 4%, down 3 basis points on the session, 397. That doesn't scream economic growth.
No, it's the opposite. And we've been saying, well, what's the actual story here? Neil Dutta wrote in, he said, in my experience, the simplest explanation is usually the right one. If yields are lower, it probably means that economic activity is not exactly reaccelerating, which is what you have seen in some economic indicators. However, if you take a look at the economic surprise index, it has actually turned up and is near the highs of the year. So a real confluence of conflicting narratives that come together in the toxic confusion of 2026.
How'd you make Bramo super bearish? Show her something super bullish. Block up in the pre-market by close to 20%, cutting half of the workforce.
Oh, you cannot pin this on
Come
me
on.
for being bearish, because I think that the world is looking at this and saying, is it the path of travel for the labor force in the wake of AI disruption, or is it a bloated company that acquired another firm and had a business model that needed some trimming of the fat? And that's what actually we're seeing. And ultimately, it might be somewhere in between, and you might get some layoff announcements just to get a similar boost to stock like that.
All right, AI derangement syndrome number one. I think this is purely a stock issue, as we just heard from our last guest, who is living and breathing in San Francisco. Obviously, this stock has been down more than 75% in 5 years. I think this is them just trimming some bloat, and at the end of the day, you can just pin it on AI. That's going to be the quick Band-Aid for this. We can be more efficient. I just wonder how many more blocks are we going to see in the next few weeks.
Whatever you think it is, and you can debate this all day, we will. Whatever you think it is, that stock move right there is green, and it could be a green light for the C-suite in a range of companies across the country who are looking to do the same thing and just got cover to move forward.
Look, it seems like things are moving very quickly, and anyone who's used Claude Pro or ChatGPT Pro can understand all of the ways that they can become more efficient. You are seeing people hire fewer entry-level workers as a result. There are shifts going on. There will have to be job destruction. The question is, will job creation come on board as quickly? Right now, we're not seeing it. This is the reason why the jobs number that we get next Friday is going to be so important. Do we start to see a pickup in the number of job creation at the same time that we see destruction? It might not be, Armageddon here, but we're talking about a real shift. And I'm not exactly totally doom and gloom, just,
Not totally.
Not totally.
Just 99.9%.
Just sometimes.
It's a gorgeous day today.
Just because you smile and laugh when you do it.
Patient zero. Patient zero.
Look, honestly, I am very sympathetic to the idea that in the past, technological advances have made humanity have a better quality of life. I'm also aware that this is a different model where suddenly it is a knowledge creator, not just the question of a job a booster. So it's a different equation. It's a fascinating moment.
I'm right there with you.
Thank you.
You're not alone. Don't worry about it. We're all right there with you. Just sort of burying our heads in the sand at the same time and hoping none of this is happening. Coming up this hour, we'll catch up with Savita Subramanian of Bank of America with AI fears continuing to weigh on markets. The US Under Secretary of Defense, Emil, with Anthropic failing to reach a deal with the Pentagon, and Alejandra Grindal of Ned Davis Research breaking down the latest inflation reading. We begin this hour with stocks adding to losses as the S&P 500 is now set to finish February in the red. Savita Subramanian of Bank of America has one of the most bearish year-end outlooks on Wall Street, 7100. She writes the following: our market call is not based on valuation mean reversion. We see many compelling fundamental and macro reasons for PEs to compress further, even in tech. Savita joins us now for more. Savita, welcome to the programme.
Thanks.
This, by the way, was a fantastic note, and I enjoyed every word of it. So let's get into some of it.
Yeah, absolutely.
This market, this index has changed. It's not what it was 10 years ago. What is it now?
Yeah, I mean, I think one of the bull cases for the S&P 500 and why it should trade at a higher multiple is that it has morphed from this really manufacturing-intensive index from the 80s and 90s into a very asset-light, innovation-oriented index today. It's 50% of it is tech and healthcare. These are not manufacturing companies, or so we thought a year or two ago. And that's what worries me a little bit, is that you're starting to see tech do all the things that lead to multiple compression. So I guess I'm not surprised that we've seen pretty significant PE compression over the last few months. First of all, they're levering up, maybe not to extremes, but this is probably the most important driver of lower PEs, is having higher financial leverage. Second, they're becoming more capital intensive and clunky, right? So, 15 years ago, they spent 0% of their free cash flow on manufacturing CapEx and, kind of real CapEx. Today, it's closing in on 90%. That's what we're seeing by the end of the year. So this is an industry that's spending more of their free cash flow on CapEx than energy companies. I mean, it's a weird world when you think about it. And I guess the hope is that revenue comes in spades enough to offset this leverage and this spend on manufacturing. But I think that's TBD. And right now we're forced to just buy the dream. And I think investors aren't necessarily willing to pay as high a multiple for that dream.
What do you think the appropriate multiple is now?
Look, I mean, I think the multiple itself relative to the S&P 500 should be a bit higher, but not that much higher. Like a year ago, we were, in an environment where tech stocks were trading at, maybe the highest multiple to the S&P since the tech bubble. Now, I think they've compressed, but they're not necessarily trading at discounts. They're not trading even in line with kind of long-term averages. So when I look at areas, and then on top of that, when you have a disruption scenario, it could take a while, right? Like when you look at IT services, this sector was disrupted by ChatGPT, and it basically went from trading at about a 25% premium to the S&P. The industry derated to about a 20% discount. Software, semis still trade at a premium to the S&P 500, and I think that's where we really have to think hard about it. The other component, I think you have to watch earnings, because multiples are a function of price and earnings, and I think what we may see over the next few years, months, quarters, is potential relative downgrades to tech earnings in favor of other areas of the market. So to your point earlier about kind of this disconnected economic cycle, it kind of feels like we're going back to the 80s a little bit. So we're going back to this more manufacturing, kind of make stuff in America type of market, which hasn't been great for multiples. Maybe the consumer takes a little bit of a hit because we're now seeing these layoffs. So I think we have to recalibrate and think about what's actually happening to the index and where you want to be.
So I was looking at the range. You've got a 7,100 target. You've got a range from 5,500 to 8,500.
Yeah.
Has the range ever been bigger?
Oh, yeah.
Okay.
It has been bigger. I mean, there have been years where we thought it was, just sort of a binary buy or sell. So this year, I think we're actually in kind of good normal territory. A lot of the curveballs are, we think, behind us, like when it comes to tariffs, when it comes to policy. Ahead of us, we just have, an environment where companies are incented to spend more money. We've got the Big Beautiful Bill Act. We have a lot more certainty around tax reform. We kind of know what the next few years look like. Maybe we get gridlock in the next upcoming election, and that could be, a benefit for companies. We've generally found stocks do best in that scenario.
Could we see a scenario where Block is actually a front runner of a lot of other companies that do layoffs and see their stock prices boom, where you start to see an economy where you have a jobless rate increasing at the same time that you have a stock market that's absolutely booming?
So crushing.
Is that actually something that you could foresee?
I mean, I think it could happen. Maybe it won't be as dramatic as, everybody, is unemployed except for a few billionaire, trillionaire types. I don't think we see this dystopic world, but I do think that the worry is that the engine of consumption growth in the United States has been, 25 to 45-year-old professional white-collar services employees, right? And college grads that get jobs, buy houses, have kids, do all the things. And that area of the market right now is in the lowest demand that we've seen historically. We're actually seeing a higher unemployment rate for 25-year-olds and college grads than we've ever seen. Now they're going back to grad school, incurring more debt. I think that's the other kind of thing we need to think about is how does that whole educational system change? The new jobs that are being created, though, it's interesting. You're seeing them in, kind of skilled manufacturing. So I think it's an interesting trade-off where you've got electricians now commanding these huge salaries for tooling up data centers, but your coders and your tech folks and your salespeople are underemployed. So I think that's the way we need to think about the future is kind of that trade-off between manufacturing versus asset light. Multiple compression is generally what one would expect. On top of that, I'll give you one last thing.
Sure.
So the key reason that we're expecting multiple compression is we're actually very bullish on earnings. So this year we're forecasting, I think, amongst the highs on Wall Street in terms of earnings growth. So we have a very low target, but a very high earnings forecast. And generally what we found during years of strong earnings, strong economic data, the market doesn't do that great. It's already anticipated all this good stuff that's going to come, and it generally trades kind of sideways. So I think that's the call for the year.
It's been hard to be bearish, the equity market, for a long, long time because the buybacks have been so large.
Yes.
There's a point in your note about supply. And not just the buybacks, but the IPOs we're going to see potentially later this year too. How critical is that a piece of your call?
I think that's huge because if you think about the last 20 years, we've had this wonderful shrinkage argument going on, right? We've had accelerating buybacks, no IPOs. IPOs stay private longer. They only come to market in kind of full maturity. So I think that that's been a boon for equities because there's fewer stocks to buy. It's a key supply demand story. Today, when you look at the three biggest private equity plays in the U.S., they're all tech, and they're valued at something over $1 trillion. If we saw all three of them IPO, that would be more than all of the issuance proceeds we've seen over the last 15 years. I mean, it's kind of a crazy setup in terms of supply coming online in equities. And then in IG, investment grade, we've already seen supply increase pretty demonstrably. It's been absorbed, but I think at some point, maybe we don't have such a strong appetite for tech debt.
The numbers are massive. Savita, it's good to see you.
Great to see you.
Fantastic research, as always. Savita Subramanian there of Bank of America. Equities declining this morning. Let's get you an update on news elsewhere with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. We are seeing shares of Block surging nearly 20% in the pre-market. The company announcing it's cutting its workforce by nearly half, or 4,000 employees, with CEO Jack Dorsey saying AI is changing the future of labor productivity, adding, "I don't think we're early to this realization. I think most companies are late." Within the next year, the majority of companies will make similar structural changes. Netflix dropping out of the bidding war for Warner Brothers Discovery, the move clearing the way for Paramount to clinch its deal for the Hollywood studio, pending regulatory approval, of course. Netflix saying the deal is no longer financially attractive after Paramount's latest $31 a share offer. And former President Bill Clinton will testify before Congress today about his relationship with the late convicted sex offender Jeffrey Epstein. His wife, former Secretary of State Hillary Clinton, denied any association with Epstein during an hours-long deposition yesterday. Clinton told reporters she is confident her husband knew nothing about the crimes. That's your Bloomberg Brief, John.
Yahara, thank you. Thanks for the update. Up next on the program, an exclusive conversation with the U.S. Undersecretary of Defense Emil as the clock is ticking on the Pentagon's critical Anthropic deadline. That conversation up next from New York City this morning. Good morning.
There's some component here that's AI driven and efficiency driven, but some component of just natural trimming of the portfolio of employees. They said AI, but it's not entirely AI, but you're going to see some of this across the board in other companies as well.
Some disagreement here. What was behind those big cuts to the labour force over at Block? That was Dan Dolev of Mizuho. In the equity market at the moment, we're declining by 0.7% on the S&P 500. Similar move on the Nasdaq, on the Russell. Underperformance down by more than 1 percentage point. Talk about the bond market. Yields lower across the curve, 10 sub 4%. This is important. We keep breaking lower. 397.73 on a 10-year this morning.
And this comes amid a Fed that really hasn't been particularly dovish, and a number of economic data points that haven't exactly pointed to some sort of rapid rate cutting cycle. So is it just the economy, stupid? Are we looking at something that is disinflationary without job creation, which is a fear that a lot of people have been having?
We are trying to figure it out. AI in full focus this morning. The standoff between Anthropic and the Pentagon over military safeguards is ramping up. The tech giant facing a deadline today to accept conditions or be blacklisted. The Anthropic CEO, Dario Amodei, saying in a statement, quote, "These threats do not change our position. We cannot in good conscience accede to their request." The U.S. Undersecretary of Defense, Emil, responding to the statement, calling Amodei a liar with a God complex. The Undersecretary joins us now for more. Undersecretary Michael, welcome to the program, sir. Calling someone a liar is pretty strong language. What's he lying about?
Well, what happened is we've been negotiating in good faith on the Department of War side for about 3 months, and we're working pretty diligently. And we sent over a proposal that we thought made a lot of concessions to the language that Anthropic wanted, and then, without any notice, they published an article where we thought we were getting close, saying that they were breaking off talks well before the deadline, which is generally not good partner-oriented practice, if you will.
So, Emil, this is what they're asking for, as far as we understand. And let me share this with the audience. It doesn't want its technology used for surveillance of US citizens or for autonomous lethal strikes without a human in the loop. That's the ask. What were the concessions?
Yeah, the concessions are pretty simple. We agreed in writing to ensure that the Department of War was following all laws and regulations, including the National Security Act of 1947, the FISA Act, and all other applicable laws and regulations, because mass surveillance of Americans is already illegal. So we were offering to put all of that language and affirm that we were following all laws in the contract. When it comes to autonomous weapons, similarly, we said we'll follow all laws, including a DoD directive that's been in place for years that governs how we would use any such weapons. And then we affirmed that there would be human oversight over every kind of part of the development process or engagement process or use of autonomous weapons. And he didn't like the word, I guess, as appropriate at the end of that sentence. But we believe we conceded to all their substantive demands. So it was surprising that out of nowhere they'd cut off negotiations.
So it appears that your differences are actually minor. Would that be accurate?
Yeah, and that's what was surprising, is usually if your differences are minor, you get in a room, you try to hash them out, and instead, without any notice, publishes something about his conscience, and then doesn't engage. And it was difficult to understand why, because we were working pretty diligently on this. And we were at the final stages of a few words here or there where we agreed to what they wanted. So in substance, it was very surprising, given that we negotiate with hundreds of technology companies, and this is the only one we've ever had that behavior from.
Are you still weighing using the Defense Production Act to compel Anthropic to basically have to use its product, or potentially are you weighing still making it a supply chain risk, which we heard from Anthropic say that this is almost contradictory proposals?
They're two different things, and I think depending on how today goes, at 5 o'clock, the Secretary of War, Pete Hegseth, gets to make the decision on how to reply. I've maintained my openness to continue dialogue through that deadline, but they've seemed to have launched sort of a PR campaign that was planned well before these negotiations sort of restarted on Tuesday. So I don't know. Their behavior is frankly unpredictable. I'm not sure what to expect.
So do you plan, though, on having more talks today, or does a decision just need to be made by today?
I offered more talks, so long as they're in good faith. We're always open to talks, and we set a deadline, and we met the deadline. And up until that deadline, I'm open to more talks, and I told them so.
So what does happen at 5:01 today if there's no agreement between the DoD and Anthropic?
That's up to Secretary Hegseth. We have some courses of action that he's considering, and ultimately this comes down to the warfighter, right? It comes down to, for any AI system we might use, are we using it to protect our warfighters in the right way? Are we using it to sort of give them the best tools to be efficient and to be lethal when they have to be lethal? And that's the primary thing in Secretary Hegseth's head. And we told them that ultimately, at the end of the day, we follow the law, all laws, but we can't let any one company stand between us and the warfighter because they don't make the rules. Congress makes the rules. The president signed them. We execute them, and we do so safely.
Well, speaking of the president, has he weighed in on this specifically? Has there been discussions with him and Secretary Hegseth and yourself as well?
This has all been internal to the Department of War so far.
Okay, and then when it comes to potentially the other AI negotiations underway, what is going on right now with XAI and to get Grok on classified networks?
Well, I think the smart approach, when I came in at the Department of War about 9 months ago and looked at what we were using AI for, and it was some pretty minimal use cases. And given the power of the technology and the potential power to do good for the U.S. military, both from an efficiency standpoint and a strength standpoint, I wanted to make sure we had a lot of options. So we went around and we've launched Google for unclassified networks. We've signed XAI for classified and unclassified networks. And we want to continue to provide options to all of our components here at DOW. And that's what we'll continue to do. And it's just smart to to have more than one option so that we can see the strengths and weaknesses of each model and learn from them as the AI revolution begins here.
Undersecretary Michael, is lethal autonomy really so critical for future national security?
It is. I mean, if you think about it from a defense standpoint, whether it's a drone swarm that's coming at a military base, whether it's a hypersonic missile coming at the United States, where the reaction time against the sort of, how many weapons are coming at you, you want to be able to take them down potentially faster than a human could alone, if that's how it's done. And we're learning from the Russia-Ukraine war with the drone swarms and so on, and with the new weapons that have been developed all over the world that changed the name of war, the game of warfare, that we've got to respond and defend ourselves in any way we can. The question is, do you have a human on the loop to make sure that we're monitoring these systems? And that's what we proposed in writing, in language, that we always have human oversight over these things. But they're necessary given what's happening in the world.
Emil, clearly the technology these companies are producing is tremendously powerful. Yet you believe this individual is both a liar and has a God complex. How concerned should the American public be about individuals like this running companies like this, if that's what you believe this person is?
Yeah, I think there's some concern that, when you have leaders of some of these companies talking about unemploying 70 million Americans, the lawsuits they're under for sort of scraping content from content publishers and having billion-dollar lawsuits against them, using that content to make profits. And then really what's concerning is making their own policies that sort of could sit on top of democratic policies that are voted on by the people, passed by Congress, signed by the president. You do have to worry about, are they taking it too far? Are they trying to do and impose their own views on the American people in an undemocratic way? So I think those things are going to be things we're grappling with in society for the next several years as these companies get bigger and bigger.
We're looking forward to having the conversation with you, sir. Thanks for making time for us this morning. Emil Marker there, the Undersecretary of Defense. Up next on the programme, the latest PPI data set to cross. We'll get reaction from Alejandra Grindal of Ned Davis Research from New York City. You're watching Bloomberg TV. Session lows, a wild ride into month end. Equities down by 0.75% on the S&P. On the Nasdaq, a similar amount. On the Russell, negative 1.3% in the bond market. Yields down across the curve, down by more than 25 basis points on the month on 10s. A break of 4%, 397. Yields lower by 3 basis points on 2s. A break of 340, 339.94 on a 2-year yield. With your PPI data, Mike McKee drops by for more. Good morning, Mike.
Good morning, John. We come in hotter than anticipated with the PPI for final demand up 0.5%, the same as in December. The forecast was for a 0.3 rise. Take out food and energy, and we're up 0.8 after 0.7 last month. And take out trade to that, and you're up 0.3. That one's down just a little bit. Last month, we saw a big rise in trade services, and that is not happening this month. On a year-over-year basis, headline 2.9. Ex-food and energy is 3.6, and ex-food and energy trade 3.4. The core rate, the 3.6, is a significant increase over the 3.3% we saw last month, while the 2.9% headline down a tick on a, basis effect from last month. But these are all important, not just for the headline numbers, but because a lot of the PPI feeds into the PCE, which is, of course, the Fed's indicator. I'll look some of those up now while you're giving us the market reaction to all of
Mike
this.
McKee, thank you, sir. What do you do with that? An upside surprise on PPI. Yields were down. It was a break of 340 at the front end of the curve. We erased some of that move. We're back to 340. 10s were at about 397. We're back to about 398. Yields are still lower on the session. In the equity market, when the data dropped, so did the stock market. We're just about holding on to some of those levels. On the S&P, we're down by 0.9, down by almost 1% on the Nasdaq. Look, first look, just taking a step back, there are some members of the committee on the FOMC right now worried about inflation. It's why they've established, for some at least, a prolonged pause at the Federal Reserve. And if you're worried about a downturn, in financial markets and hoping the Fed's going to step in and bail you out. With numbers like that, you're not going to get a hand from the Federal Reserve.
What's interesting to me is that the stock market responded more than the bond market because yields are still where they were. So it's not exactly underscoring any kind of acceleration in economic growth. I mean, sure, you had a little bit of a retracement of some of the downward move in yields, but still a bit into bonds, even as you have inflation coming in hotter than expected. So what exactly is going on here? What are people looking at if it isn't inflation and if it isn't necessarily the path of rate cuts by the Federal Reserve, even if the stock market is looking at just that?
Pure risk aversion at the moment, it seems, building over the past few weeks. Mike's going through the numbers for us. Upside surprise across the board here on PPI. Mike, you're digging into it. What do you see?
Well, a couple of the things that feed into PCE are up, of course. I don't have the exact way they will feed in terms of what they will mean, but portfolio management, which has been a problem, up 1.5%, and international airfares 4.3%. So some significant rises in some of the things that will feed into the PCE numbers. And given what we're seeing here on the headline, it pretty much guarantees that the January PCE numbers are going to come in somewhere around 3 or north of 3. And that's not going to give the Fed any kind of reassurance that inflation is going toward their target.
Mike McKee, thank you, sir. Stay close. Got to talk about OpenAI as well, because AI and the economy right now is basically the same thing. This headline crossed just moments ago. OpenAI saying Amazon will invest $50 billion, $50 billion. The initial investment, $15 billion. So OpenAI, big capital raise this year, big year for that company, getting some money.
Yeah, and expanding their pact by over $100 billion over 8 years, OpenAI, with respect to AWS. What's interesting to me is how OpenAI is trying to compete at the same time that you have Anthropic very much in the news these days. I just wonder how much of a battle it is and how much each of them is trying to jostle for a leg up. It's sort of like what goes on underneath the pile of bodies in a football playing field you don't actually want to know. It kind of feels like that right now.
$730 billion valuation. These valuations are huge.
To the point that you made with Savita Subramanian, it's really interesting. If they
Supply.
if they IPO this year, how much oxygen does that suck out of the room? Where does all the money come from? And what does that do to a public equity market that has actually been contracting over the past number of decades? All of a sudden, we're dealing with a pretty big expansion.
Getting some details from OpenAI as well on monthly active users, weekly active users, 900 million now. That's the latest number from them. So a big deal between Amazon and OpenAI. And to go back to your point, SpaceX, OpenAI, Anthropic, we're talking about something well north of $1 trillion, pushing $2 trillion from 3 companies, potentially all IPOing in the next 12 months. Crazy.
At the same time that people are grappling with what exactly this disruption will do and dealing with a risk-off environment, look, they're all going to be doing roadshows proving their worth. We're going to hear a lot more doom scrolling and different Substacks explaining how transformative the technology is going to be. If it is going to be transformative in that kind of way, given all the uncertainty in markets, will they be able to raise that money in the same kind of capacity that they previously were expecting? How much do market conditions play into when these IPOs come to market?
Mandeep Singh of Bloomberg Intelligence standing by for this breaking news. Mandeep, welcome to the program. These are some big numbers. How important is this development?
I mean, it's huge when you think about, OpenAI really starting off with Microsoft and now branching into this big partnership with Amazon. I think it's really huge in that context. And also, NVIDIA and OpenAI had plans to kind of partner in terms of almost 100 billion. Now that has come down to 30 billion. And Amazon is the one who is really stepping up, and there is some mention about OpenAI using Trainium chips. So all in all, you see a big ecosystem shift here from, the OpenAI original stack, which was Microsoft and NVIDIA, to now really leaning towards Amazon and kind of using Amazon's chips to develop custom models. And obviously the scale of investment is huge. And I think Amazon didn't really have a choice, given they had talked about 200 billion in CapEx this year. And there wasn't any proof in terms of what they were doing with that $200 billion investment, because they are not training their own large language model. And the cloud growth is trailing the other peers like Microsoft and Google. So this was a step that they had to take to really kind of change something in terms of their $200 billion in capex.
Mandeep, what does their access to capital look like at the moment? Coming into this year, there were real conversations had in financial circles about the potential, not the high potential, but the potential at least of this company going bust and not raising enough capital in the years ahead. How are things shaping up now?
So OpenAI, as you rightly pointed out, had talked about almost $1.4 trillion in investments and some through partnerships, some of their own. And now I think they're coming to the realization that obviously Google has caught up in terms of large language models. Anthropic models actually are faring better in some use cases. So they really had to scale back their own ambitions in terms of the capex that they could put through the debt market or private funding. And now they're leaning more towards the ecosystem where Microsoft, I think, is sort of scaling back here, or at least OpenAI and Microsoft are not getting along that well. And they had to find a new partner for this CapEx build out. And it looks like it will be Amazon. And the thing about Amazon is Amazon was a big investor in Anthropic. It still has a pretty sizable stake there. But clearly, Anthropic has been using Google more, and they are leaning more towards using Google TPUs. And now NVIDIA has an investment in Anthropic as well. So from that perspective, they're all kind of using each other's cloud and each other's chips now. And it's all about how much funds you can raise to establish your lead.
They're raising serious money and developing serious technology. And Mandeep, that's hammering the labour market if you work over at Block. I want to squeeze this in with you. Your thoughts on this move? 20% rally in the pre-market on this name. Is this the real deal?
I mean, a lot of these companies are not going to grow at the same rate that they grew, around the pandemic and subsequently for the next 1 or 2 years. So given that growth rate is decelerating for a lot of software companies and there is more disruption on the horizon, I think fixing the cost structure is almost an imperative. Obviously, the 40% layoff was pretty surprising in terms of the scale, but you're better off doing it in one round as opposed to having 3 or 4 rounds of layoffs. So from that perspective, I think we may be surprised, but there could be bigger announcements in terms of the size of the layoffs.
Mandeep, thank you, sir. A lot of us are bracing for that. Mandeep Singh there of Bloomberg Intelligence. Joining us now, Alejandra Grindal of Ned Davis Research. Alejandra, welcome to the programme. We're talking about the economy, PPI's hot, talking about the labour market, and it takes us straight to tech. How would you describe the moment we're in this economy?
A little uneasy. So we saw the inflation numbers come out this morning. We've been under the view that inflation will remain hotter in the first half of the year, probably throughout most of the year, but more so in the first half of the year. And this latest data confirms it. Obviously, we're still seeing tariff pass through. Mike McKee, I haven't had a chance to look into the details, but Mike McKee mentioned airfares, financial products that's going to feed into the super core. So obviously a lot of jitters on that point. From the broader economic standpoint, I mean, we look at a fair share of pieces of data that we use to gauge, say, recession risk or even slowdown risk. And for the most part, they're still holding up reasonably well. So overall, we think the economy is hanging in there, but with the high inflation and then obviously a lot of jitters on the employment front and all these announcements of layoffs, we're sort of at this, important juncture. And I would say within the second half of the year, I think the Fed is going to take a closer look at easing policy. I think that's the bottom line.
And it seems like, Alejandra, you're looking at a bond market that is kind of looking through a hot PPI. You're still seeing bond yields lower at the front end. And yet there doesn't seem to be the economic data that justifies it just yet in the minds of a lot of economists who come on this show. Do you think that right now the bond market and frankly, economists are listening more to the idea of what happened at Block than they are about what's happening last month in the jobs picture?
So, yeah, I mean, I think there's just a lot of jitters. So as we got into this year, we knew the past 2 years and broader equity markets had been quite strong. And this year, maybe not may not quite be as strong just because we've had such a long run. Sometimes it's really hard for it to maintain that strong momentum. There's also downside risk coming from just, regular cycle with midterm elections, maybe a little bit in the change in the Fed. Many times markets tend to test the change in the Fed as well. So I think there's some factors in there, but I think, the overlying view is still continuation of U.S. economic growth.
How important is next Friday's labor market report in light of some of these jitters? In other words, how much could a weak labor market report for February spook economists much more and highly disproportionately to one that looks pretty good?
Yeah, I mean, we're definitely climbing a wall of worry. So I think if we do get that weaker news with the labor market, again, there's a lot of labor market indicators we need to be looking at besides one, but we know people tend to respond quite a bit to the payrolls report. I do think there would be a reasonably negative reaction for sure.
The jobs report a week away. Alejandra, appreciate your time. Alejandra Grindal there of Ned Davis Research. Joining us now to talk about this bond market, Ed Al-Hussainy of Columbia Threadneedle. Ed, welcome to the show. I guess we should start with this. What are 10s doing sub 4%? What's driving us down?
Yeah, I mean, look, I think the economic backdrop that your guest just went through is still quite stable. There's a little bit of upside risk to inflation here at the start of the year. That factor has been really well socialized. But if you look at rates, we have shifted our focus, I think, a little bit away from the inflation story and a little bit away from the labor market story. And we're really focused on the downside to risk. Credit spreads are unwinding. There's a bid for liquidity. You see it very clearly in private credit. And equities are feeling, quite wobbly. So I think rates are increasingly focused on the downside to risk assets.
Is that something you're worried about, Ed, or are there opportunities opening up in risk?
I think it's early days. There are definitely, I think, opportunities opening up in credit at a sector by sector basis. The software sector has been beaten up. You can see some early opportunities in the loans market where the concentration of software is really high. But if you take a step back overall, investment grade high yield spreads are still extraordinarily tight given the risks in front of us. So the overall risk story is things are still quite rich. And so if you are a bond investor at the moment, having a little bit of your portfolio in a safe asset, in a liquid asset like a treasury, starts to look a lot more attractive than it did 3 or 6 months ago.
Ed, earlier this year, everyone was going into emerging markets, into the developing world. They thought that it was going to benefit disproportionately from a global growth boom. And I wonder if you think it's the same with respect to AI developments and displacements in the labor market. Do you think that people are overlooking the displacement that could happen in developing markets as they look to diversify away from the United States?
Boy, that's an extraordinarily hard question. I feel like I don't have a lot of smart things to say in terms of the impact the AI is going to have on labor markets. It's in many ways a little bit more of a medium-term story. The shorter-term concern here is much more focused on financial markets, much more focused on the damage that AI is doing to risk valuations. And that can happen in the course of the next couple of months. That can happen in the course of the next couple of weeks. The labor market story is going to be with us for a long time. I think we're going to be debating the impact of AI on labor markets on productivity for years to come. Markets tend to be a little bit more short-term focused. And at the moment, the clear risk is downside to equities, downside to credit valuations, and this bid for essentially safe haven. What happens globally is, I think, an outstanding question.
Well, Ed, and I'm sure that we'll have to look at that in the months and years ahead. I'm just wondering how much of this risk aversion you see as stemming from private markets, in particular, some of the recent jitters that we've seen around loans and around BDCs.
Absolutely. I think the clue that I'm getting from those markets is not necessarily that default risk is spiking. It's more a symptom of the fact that there's a bid here for liquidity. Investors are becoming appropriately more nervous given the starting valuations in these risk assets at the beginning of the year. They're looking for that liquidity, and you're not going to find it in private markets. You're not going to find it in private credit. That's why those valuations are getting dinged. It's much more that bid for liquidity. And that's confirmed by what we're seeing in rates. It's confirmed by what we're seeing in the bid for high quality bonds. When we zoom out and we look at perhaps the second half of the year, I think that default risk is going to come more into focus. If the economy slows, if the labor market slows, those default risk expectations are going to have to move higher. And investors are going to essentially demand a much higher risk premium than they do at the moment.
Ed, it's good to see you. Interesting thoughts. Ed Al-Hussainy there of Columbia Threadneedle. Interesting thoughts on this bond market, and a word of caution in there too. With 10 sub 4%, even with a hot print on PPI.
That screams to him risk aversion ahead, and it isn't done with respect to credit widening, credit spread widening, as well as equity risk off.
Up next on the programme, we'll recap this morning. What a busy morning this morning. We'll look ahead to the weekend, of course, and to next week. Payrolls Friday, just around the corner.
I've maintained my openness to continue dialogue through that deadline, but they've seemed to have launched sort of a PR campaign that was planned well before these negotiations sort of restarted on Tuesday. So I don't know. So their behavior is frankly unpredictable. I'm not sure what to expect.
That was the U.S. Undersecretary of Defense, Emil, weighing in on the tension between the government and Anthropic right now. And this, unfortunately, has become very, very public.
Which is so interesting. This is public. This is out in the discourse about what they actually are fighting over in terms of rules of the road when using AI. He said it was surprising that Anthropic cut off negotiations, I guess, that statement last night. But at the same time, he did say to Dario, we will be willing to have these conversations today. So I don't know, potentially they get to some sort of agreement by 5:01.
Look, this disagreement highlights how transformative AI is going to be and how some of the tech executives are holding strings that are making some people at the government uncomfortable. How that conversation evolves is going to be of the utmost importance, and I think a lot of people are watching.
Unclear if we pass this deadline, what happens? There is a deadline. Here's the trading diary. Let's talk about that deadline. 5:01 p.m. Eastern Time, the deadline for Anthropic to make a deal with the Pentagon. Into next week, Monday, ISM manufacturing data. Tuesday, results from Target. Wednesday, the Fed's beige book and earnings from Broadcom. Thursday, another round of claims plus results from Costco. Then the big one, the payrolls report just around the corner. Now, typically I'd tease Monday and say coming up on Monday. But things are changing here at Bloomberg TV. Coming up tomorrow, the premiere of Bloomberg The Weekend, hosted by Bloomberg's David Gura, Christina Ruffini, and Lisa Mateo. This weekend, David Gura, good to see you, sir.
Good to see you as well. I blame you for this.
Why is this my fault?
The real surveillance heads, the OG surveillors, will remember every Friday used to tweet weekend.
That is
simply.
true.
And I think our bosses took that as a call to action, and now they've launched this show.
That is true.
We will be live every Saturday and Sunday, 7 to 10, and obviously a lot is happening over the course of the weekend. Major events, small ones too. We're going to be covering those live on air, on TV and radio, streaming as well. But this also just gives us an opportunity to have some broader, deeper conversations about the news in the past week and what's coming up as well. So I'm embracing it.
We've got to take a breath.
Yes, exhale as well.
This has been breathless over the past 2 months, and we've said this feels like the longest quarter in financial history, and there's still one more month to go. What kind of things are you and the team going to focus on, given the kind of things we've seen with Block, with AI, the tension with Anthropic, the conversation we had with the government just moments ago?
Yeah, I was thinking how often we get letters, emails, notes from chief economists, kind of not on the data release of the week or what's happening in the markets, but stepping back more broadly to have conversations about productivity and AI. We're going to feature a lot of those longer form conversations. We're going to focus more on politics as well. Hakeem Jeffries, the minority leader, is going to join us on the show tomorrow on the heels of that Democratic retreat up the Potomac River outside of D.C. So we're going to be keenly focused on markets and the economy over the course of the week. And tomorrow, Berkshire reports, which I was not expecting, but there is a company that reports on a Saturday.
There you go, that's exciting.
Greg Abel is going to give us his first annual letter tomorrow. We'll be covering that live at 8 o'clock in the morning, and then focusing on politics as well.
Looking forward to it. David, congratulations.
Thank you.
Great to have you back on the TV over the weekend
Glad
too.
To be here.
Are the donuts going to be in the middle?
We'll see.
We're going to make
Tune
that
in,
happen.
everyone, please.
Okay,
There'll be
make that
gluten.
happen. 7 a.m. Did you negotiate that?
Well, it's very early, Joe. Not for you. But,
no, that's nothing. Should we take 7 a.m.?
That would be amazing.
You'd like 7 a.m.
Yeah. That
7
would
a.m.?
Be life-changing.
Late wake-up call.
I'd love that. 7 a.m. Sounds great.
Trying to
tune in tomorrow, of course, 7 a.m. Eastern Time for the premiere of Bloomberg This Weekend. Coming up on Monday, Laurie Calvasina of RBC Capital Markets joins us, Kathy Jones of Charles Schwab, Barbara Reinhardt of Voya Investment Management, Darryl Cronk of Wells Fargo, plus a big conversation at 2 p.m. Eastern Time Monday. Catch Lisa's interview with the JP Morgan Chase chairman and CEO, Jamie Dimon, and I imagine the word cockroaches is going to come up in this a few times.
Yeah, the big question about how much the cockroaches are coming to the surface with respect to private credit concerns and what he sees there. He's been very vocal about that, the idea that, clearly there's some bad actors here. He also has been really vocal on artificial intelligence and what that's doing to the workforce. So those two ideas are actually working in tandem, the disruption that's causing some of these cockroaches to come to the surface, his words, and what that does to
And I
us
wonder if
today.
he's going to tell you who he thinks lately is doing some dumb things.
Probably not, but yeah, maybe.
Some dumb things are happening in finance, that's for sure.
Yes.
And some big moves are happening in financial markets. The most interesting time in financial markets for a long, long time. Going into the opening bell, just around the corner, 35 minutes away. Futures at session lows with negative 0.8% on the S&P 500. In the bond market, yields breaking through 4%. 398, we're down 2 basis points, even with a hot PPI print just 25 minutes ago.
This, to me, is a huge moment. The idea that you could get data that goes against the move that you're seeing in the bond market says to it, I don't think so, and keeps going. That tells you something.
From New York City, you don't get to rest. We're even here on the weekend. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.